Lydian, do you have the question with you? Perfect, perfect. Okay, so what are we told as far as this particular question here is concerned? So this is a very good question on conversion of partnership business into a limited liability company. And the question is, that is specifically part B. So we are told John, Kelvin, and Renette have been into partnership for several years, sharing profit and losses in the ratio of 5:3:2 respectively, after allowing for a 10% interest on fixed capital balances of the partners. No salaries or commissions were to be paid to the partners. The trial balance is at 30th of June 2024, extracted from the financial records of the business, revealed the following. So we're given the trial balance there. One, we have the profit for the year. We have the inventory as at 30th of June, of 2024. Account receivables, account payable, bank overdraft, property at carrying amount. Remember, I've said carrying amount is the same with the net book value. That is what you need to remember. We have the motor vehicle at carrying amount, office equipment at carrying amount, equity investment at fair value. We have the partners capital account, partners current account drawings, and then we have the loan from Kelvin. We have additional information. Number one, you're told actually in the first paragraph there, we are told the partnership was converted into a limited liability company, JKL Limited, with effect from 1st July 2024 under the following terms. Number one, you're told the purchase consideration of the business purchase was agreed at 150 million, and the new company issued 15 million ordinary supposed to be shared among who? Partners. How do we share that profit? We share that profit from what you did in the topic of partnership in financial accounting. We share out that profit by preparing something called the appropriation account. And therefore, even before we cross off the books of account of the partnership, so the first thing we need to do is to share out that profit among the partners. We are going to share out that profit by preparing something called the partners, the appropriation words, the appropriation account. So let's first of all, we prepare that account, which is called the appropriation account. So why are we preparing this account? Is to share out that profit. Appropriation what? Appropriation account. Appropriation account, and I hope you can be able to recall the format for this account, the format for appropriation account. Okay, so the figures which are given here, they are in million of shillings. So basically here, we should have two columns like that. So in preparing this particular account here, we always start with the profit for the year. Profit for the year. I hope you can be able to see that far ahead. We always start with the profit for the year. And then to this profit, we usually add the interest on drawings. We usually add the interest on drawings. The interest on what? The interest on drawings. After adding the interest on drawings which is charged to the partners, we then proceed and we raise the appropriations. When we talk about the appropriations, this is what the partners are entitled to from the partnership business, e.g. the salary and commissions, e.g. the things like what? The interest on capital and the share of profit. The share of what? The share of profit. So let's prepare this. So we're going to start by recording the profit for the year, which we are given in the trial balance, the first item. The first item in the trial balance is the net profit for the year, which is basically 42,800. Then we need to check what the partners charged any interest. When we talk about the interest on drawings, this whereby drawings is basically money or goods you take from the partnership business. The partners may have agreed that if you have taken some cash, you have taken some goods from the partnership business for your personal use, you'll be charged an interest because it is like you are borrowing from the partnership. So once you are charged an interest, that money should be added to the amount to be shared. Yes. So we must be given that in the first paragraph of the question. We are told John, Kelvin, Renette have been in partnership business for several years, sharing profit and losses in the ratio of 5:3:2, after allowing interest on fixed capital at the rate of 10%, no salaries or commissions which were paid to the partners. And then if you go to the additional information number 1 all the way to note number 5, there is nowhere we are told the partners were charged interest on drawings. Because if you go to the trial balance, down there, above the loan from Kelvin, we have drawings. So, but there is nowhere we are told the partners were charged interest on what? Drawings. But if there was any, we should add it here so that we get the amount to be shared among partners. So this is what the partners will share. So how do the partners share out this? So this one will, or basically what we do, we list now the appropriations. Appropriations basically refers to any amount of money which the partners are entitled to from the partnership business, like maybe the salaries, all what, all commissions. And there is something which you're told in paragraph 1 that the partners were not entitled to salary, they were not entitled to commission. So what they were entitled to, as per the first paragraph, is the interest on capital. Interest on what? On capital. So what we need to do here is to compute the interest on capital which each partner was entitled to. As per the first paragraph, we are told the partners were entitled to interest on capital at the rate of 10%, and this one should be computed based on the fixed capital balance. This one should be computed based on the capital contributed by each partner. So if you go back to the trial balance, we're given the capital account balance of each partner. The capital account balance of John, Kelvin, and Renette. So what we need to do is to compute the interest on capital which the three partners were entitled to. That is John, Kelvin, and who? And Renette. So, and we are told that this one would be 10%. This one would be 10% of their capital account balance. So their capital account balances, this is something we are given in the trial balance. I hope you can see those capital account balances. So the capital account balance for the first partner, who is John, is 43,700, which 10% will give us 43,70. Then Kelvin is 28,500. 10% of that will be 28,50. Then Renette is 18,800. 18,800. 10% of that will be 18 what? 18,80. 18 what? 18,80. So remember, this is what the partners will be entitled to, will be paid, and this one has to be paid. This one has to be paid from this. This one has to be paid from what we have up there. 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 You're saying my video is not clear. I can see from my side is clear. I can see from my side is clear. Is the video not clear? Maybe someone to confirm. Is the video not clear? I can see from my side it's clear. Yes, from my side is very much clear. From my side is very, very much clear. Very, very much clear. Very, very much clear. Very, very much clear. Sasa, Anna, is the video now clear? Ama bado? Maybe the internet on your side, Anna, maybe the internet on your side. I'm already in class and I can see my video is very much clear. Very, very much clear. So maybe you can exit, then rejoin very fast. Exit, then rejoin very fast so that we continue. Yes. So basically, that is it. Yes. So In our case, we have already computed the interest on capital. This is what the partners, one of the appropriation or one of the items the partners will be entitled to from the partnership business, So then from there, the other appropriations the partners may be entitled to, is the share of profit or the share of loss. So how do we determine the amount to be shared as profit or the amount to be shared as loss? So basically what we do is that we take this amount to be shared minus what we have there. Remember, you don't have salary or commission. We will rest those interest on capital. If we get a positive figure, that is a profit to be shared. If we get a negative figure, is a loss, is a profit to be shared. If it's a profit, if it is a positive, is a profit to be shared. If it is a negative, is a loss to be shared. Automatically, this one will be a positive. Because if you take 42 minus this, we're going to have a positive figure. So being a positive figure, that is a loss to be, that is a profit to be shared. So here we will have share of what? Share of profit. So can we determine the amount to be shared as profit? So we take that minus this interest on capital. So you have 42,800 minus 43,70 minus 28,50 minus 18,80. So the amount to be shared as profit, I'm getting 33,700. Now that a profit would be shared among our three partners, John, Kelvin, and who? And Renette. So they will share a profit of 33,700, 33,700. And how will this profit be shared? This profit will be shared using the profit and loss sharing ratio, which we have in the first paragraph. The profit and loss sharing ratio in the first paragraph of our question is 5:3 is to 2. 5:3 is to 2. That is for John, Kelvin, and what? And Renette. That's basically how they will be sharing the profit or the losses, the profit or the losses. Yes, the profit or the losses. Someone is asking a question here. Drawings about drawings here. No, I've said this. What are drawings? Number one, I've said drawings is when you go to the business, to the partnership business, you take some cash, you take some goods for your personal use. So whatever we add here is not drawings. We add the interest because we are saying if you go to the partnership business and you take money, you take goods for your personal use, in most of the cases, the partners will have agreed that you'll be charged an interest. Once you are charged an interest to the partnership business, it is like an income. It will increase the amount to be shared among who? Partners. Whatever we add there is not the drawings. We add the interest. We add what? The interest. Like is like an income. That's why we are adding it here to increase the amount to be shared among who? Partners. Also? Yes. So let's determine the amount to be shared by each of the partners. So the first thing we need to do here is to get the total. So this is the 810. So the amount which John will share will be 5 all over the total, 5 all over 10, Kelvin 3 all over 10, and Renette 2 all over 10. 2 all over 10. So that is basically how we compute the amount to be shared. That's how we compute the amount to be what? The amount to be shared. The amount to be what? To be shared. So we have that 700 times 5 divided by 10. So which will give us 16,850. Kelvin, we take 33,700 times 3 divided by 10. And basically that will give us 10,110. And then the other partner, the net, that is 3,700 times 2 divided by 10. And basically that will give us what? 6740. 6740, yes. So then we know that this amount now has been shared among partners. So therefore, if you take this amount and then you less all this, you should get 0, because that amount of profit has been shared among who? Has been shared among partners. Now, once we are through with that, then we can proceed and basically cross off the book of account of who? Of the partnership. I want us to move and cross off the books of account of the partnership by preparing the 3 accounts which we are required to prepare in our question. So the first account we are required to prepare is the account which is called the realization account. The realization account. Realization account. So what we just need to remember here is, what do we record in this particular account, the realization account? What do we record in this account? And our figures will be 1,000 of shillings. Will be 1,000 of shillings. This is basically the debit side. So the realization account, we have a number of items to be recorded here. Then from there, in Roman 2, we are required to prepare the partners what? The partners current account and the partners capital account. Partners current account. Partners current account. Remember, this account is also, this one is a ledger account. Is a ledger account. Partners current account is basically a ledger account. Ledger account means that this account will be having a debit and the credit side. The debit and the credit side. But here, taking into account, we have 3 partners. On the debit side of this account, we have the details column, and columns equal to the number of partners. How many partners do we have? We have 3 partners. So we will have the details column here, and then column for the 3 partners. We have the first partner, who is John. We have Kelvin, and we have Renette. And also our figures here will be 1,000 of shillings. Will be 1,000 of shillings. So we do the same on the credit side. Details column, John, Kelvin, and Renette. And also our figures here will be in 1,000 of what? Of shillings. And then Roman 3, we're required to prepare the partners capital account. So the reason why I'm having all these accounts, because I want us to prepare all these accounts concurrently. As we go through that balance, whatever is affecting this account, it will be posted to the respective account. Yes, so the partners capital account do have the same format with the partners current account. This account has the same format with the partners current account. So we have the details column, and basically columns equal to the number of partners. So we have John, we have Kelvin, and then we have Renette. We have Renette like that. So then on the credit side, we have the details column. We have John, we have Kelvin, we have Renette. This, remember, is the credit side. And also the figures are in what? In 1,000 of shillings, like that. In 1,000 of shillings. So I think now we can move and basically prepare these accounts. Let's move and basically prepare those accounts. Let's move and prepare those accounts. Let's move. Now, how do we prepare these accounts? Now, what we need to recall is, for example, what do we record in this account? Remember from our discussion, I've said when preparing this account, we record like 3 key items. In preparing the realization account, I've said on this side, we record the assets, which are taken over at the carrying amount of the net book value. On this side, we have the liabilities, which are taken over, and the purchase what? Consideration. That is the first thing you need to remember, what we record in this account. Asset taken over, the liabilities taken over, and the purchase what? Consideration. Then, if it is now the partner's current account, you need to recall whatever you are recording here in financial accounting. In financial accounting, when you're preparing this account, you are recording the partners, the opening balance in this account, in this account, and then on this side, you are recording, I think, 3 items: the drawings, interest on drawings, and share of loss. On this side, you are recording the share of profit, the salary to partners, the commission to partners, and the share of profit. And then this account generally we record the opening balance, the partners, or the opening balance in capital account, and any loss or gain on realization, which you have said must be shared among partners using the profit and loss sharing ratio. But basically what we need to do when closing off the books of account of partnership, what you do for you to get it right, go back to the trial balance which you're given here, and you need to cross all those accounts. You cross off all those particular accounts without skipping any. So the first item is the net profit. Now, this net profit, we know that this one has been shared among partners. And therefore, these particular items here, that is any interest on drawings, any salary or commission, any interest on capital, and the share of profit, all these, they'll be posted to this account. But even before you post these items here, we definitely need to record the opening balance here. So we are going only to post this one here after recording the opening balances. But all these items will be posted in this account. So then below that, what do we have? We have inventory. And actually what you're given here are items of assets and liabilities of the partnership. Now, what we need to do is basically to make reference to note number 2, to note number 3, to note number 4. The additional information with number 2, 3, and 4. Can we quickly go to note number 2? Note number 2, we are told equity investment, which you have said is investment in shares by the partners. This one was taken over by partners. This is an asset which was taken over by partners. Remember, you have said any asset taken over by partners should be debited in this account, should be debited in the partner's capital account, and then credited in the specific asset account. So one of the assets taken over by partners is the equity investment. Number 2, we are told the loan from partner Kelvin. That is the last item in the trial balance, was transferred to the new company. Is the liability of the partnership, it was transferred to the new company. Number 4, we are told other assets and liabilities of the partnership were taken over by the company. So we are given the assets and liabilities which were taken over by the company. Property, plant and machinery, motor vehicle, office equipment, inventory, account receivable, account and the current liabilities. All those were taken over by the partnership. So having that information now, we can go back to the trial balance, the second item. So the second item we have there is inventory. Inventory, as per note number 4, is one of the assets which was taken over by the new company. So that being an asset which was taken over by the new company, we debit it in the realization account at the carrying amount. The carrying amount is the value we have in the trial balance. So we will have inventory here. This is basically one of the assets which was taken over, and its carrying amount is the value we have in the trial balance. Note the value which is given in note number 4. So the carrying amount for this is basically 28,400. 28,400. Below that, we have account receivables. As per note number 4, still account receivables was still taken over by the new company. So this is the other asset which was taken over by the new company. What is the carrying amount? The carrying amount is still the amount we have in the trial balance, which is 23,800. And I hope you can see I'm not even considering the values we have in note number 4, because we are going to use those values when opening the books of account of the new company. But when crossing off the books of account of the partnership, I've said we account for those particular assets at their carrying amount or the net book value. Sasa, yes. So below account receivables, we have account payable. Account payable is a liability. Now, what still we are told in note number 4, we are told all current liabilities were still taken over by the new company. So the liabilities which are taken over by the new company in our realization account, they should be credited. So that being a liability taken over by the new company, we credit it here. So their value for that is, the carrying amount for that is 32,700. Below that, we have bank overdraft. Still, that is a current liability. As per note number 4, it was still taken over by the new company. So we credit it here. The bank what? The bank overdraft. The bank overdraft, which is how much? Which is 68. So then we go to the other item, which is down here, and that is the property at carrying amount. Property, as per note number 4, still it was taken over by the new company. So that is an asset which was taken over by the new company. What is the carrying amount in the trial balance? 72,950. I hope you can see still I'm not using the values we have in note 4. Those are the fair values. We are going to use them when opening the books of account of the new company. Below property, we have plant and machinery. Still, as per note number 4, plant and machinery was taken over by the new company. So we debit that here at the carrying amount, which is in the trial balance. That is 730. So below that, we have motor vehicle. Still, as per note number 4, motor vehicle was still taken over by the new company. The carrying amount of motor vehicle is 10,580. Below motor vehicle, we have equipment. Still, as per note number 4, equipment were taken over by the new company. The carrying amount for this is 240. So, and then from there, we have equity investment. Equity investment, this one, was taken over by the partners. So being an asset taken over by partners, are we supposed to debit that here? No. We have said those assets which are taken over by partners, they'll be debited in this account, the partners capital account. So here we have equity investment, but basically we need to go back to the information which we have in note number 2. Can we go to the information we have in note number 2? We are told the equity investment, note number 2, equity investment were taken over by partners at their fair value of 18 million and allocated among partners using their profit and loss sharing ratio. Now, if you go back to the trial balance, you can see we are given the equity investment, and basically we are given the equity investment in the trial balance at the fair value. The fair value given in the trial balance is 10,000, but you're told in note number 2, this equity investment were taken over by the partners at their current fair value of 18 million, and this one was shared among partners, was distributed among partners using their profit and loss sharing ratio. So basically what that means is that this particular investment were taken, when it was being taken over by the partners, it had a value of this. So therefore we are going to share, or the partners will share this asset at this value, not at 10, but at 18. And therefore, how do we account for this? Which double entry are we going to make in relation to this equity investment? Remember, this equity investment, this one is recorded in this account at this particular amount. So, and basically remember, this is an asset. This is what? An asset. So therefore, this is a debit balance on this account. So what we need to do is we cross off that account because those investments were taken over by partners. So we need, first of all, to cross off this account. So automatically we will cross off that account with 10,000. So therefore here you can see we are crediting this account, which is called equity investment, with 10,000, then we will debit this account. We will debit the partner's capital account, but this account will be debited at 18 million. At 18 what? Million. So how do we account for the difference? The difference, which is 8,000. You can see this account has been debited with 18. So this account credited with 10. So we have now to credit another account with the difference. And actually this difference, we can refer to it as a revaluation gain, because When these equity investments were taken over, they were revalued from 10 million to 18. So these are revaluation gain. Now, this revaluation gain, where do we take it? So this revaluation gain will be taken to the realization account. Will be taken to the realization what account? Because by the end of the day, we have to complete a double entry. We debit this account with 18 million. We credit equity investment with 10, and still we credit the realization account with 8. So therefore, that 8 will be credited here. It is a revaluation gain on equity what? Equity investment, which is 8. Then we need to debit this account with the 18 million. But remember, those investments were taken over by the 3 partners. That's why we are told in note 2, they will be distributed to partners using their profit and all sharing ratio. The profit and all sharing ratio we know is this: 5 all over 10, 3 all over 10, and 2 all over 10. So we are going to take the value of the investment. The investment was taken over at a value of 18 million or 18,000 for that case. So we share out that using this. So the first partner will get 5 all over 10, which is basically half, and that is 9,000. The other partner will get a share of 3 all over 10, which is basically 54. And the other partner will get a share of 2 all over 10, which is basically what? Which is 36. Which is what? 36. If you add all that, it should give us an amount of 18. That's basically how we account for that equity investment, which was taken over by partners. Let's go back to the trial balance. And I hope you can see there is nothing we have skipped there. We have accounted for all those items. What we skipped is the first item. That is the profit. Then below equity investment, what do we have? We have the partner's capital account. Now, the partner's capital account, that would be the opening balance in this account. And I hope you can see those balances in the partner's capital account in the trial balance. They are on the credit side. So what do? We record those balances here and we record them as credit balances. So the capital account balance for Kevin has a balance for John, that is 43,700, Kevin 28,500, and Renette 18 what? 18,800, 18,800, 18,800, 18,800, 18,800, 18,800. Sasa 18,800. Yes. So then from there, below that we have current account balances. Current account balances, those are balances to be recorded in this account. So, and equally, I hope you can see the current account balances, they are credit balances. In the trial balance, they appear on the credit side. For John is 14,790. For Kevin is 12,960. 960, and basically for the net is what? 98.50. 98 what? 98.50. 98 what? 50. 98.50. So then below that we have drawings. We have drawings. Where do we record drawings? Drawings, those ones are supposed to be credited, to be debited in this account. Remember, I've said from whatever you did in financial accounting, you should be able to recall what we record in this account. On this side, we record drawings. In case we had any interest on drawings, that one should also be debited here, but I hope you can remember you don't have any interest on drawings. In case we have share of loss, that one equally should be debited here. And then in this account on the credit side, we record what? We record any salary or commission to partners. Do we have any salary or commission to partners? None. Then we should also credit this account with interest on capital. And I think we have that. And then also what? The share of a profit. The share of what? The share of profit, like that. Sasa? Yes, Doris, what you have said is that the investments which were shared by partners, they are shared at a value of 18 million. At a value of 18 million. That's what you're told in note number 4. We have shared out this investment at a value of 18 million. That's what you have said. That's why you have said we debit the partner's capital account at 18 million. So if you add all that, should give us 18 million. Yes. Now, what I want us to do before we move, we go back to the trial balance, I want us to record these items. Because we have recorded drawings, We have recorded drawings. Before you finalize, okay, I think let's first of all finalize with what we have in the trial balance. Below the drawings, what do we have below that? The loan from Kelvin. And there is some information which are given in relation to that. Note number 3. Additional information number 3, we are told the loan from Kelvin was transferred to the new company at its carrying amount. So loan from Kelvin is a liability. So that loan was transferred to the new company. So that is basically a liability. That is a liability which was taken over by the new company. So the loan from Kelvin. So, and I hope you can remember liabilities taken over by the new company, they should be credited in this account. So how much is the loan from Kelvin? The last item in the trial balance. The last item in the trial balance is 91. So that is a liability which was taken over by the new what? By the new company. So I think you can see we are done with crossing all those balances, all those particular accounts which are balances at the end of the year. Now what is remaining is for us now to post these items here. So these appropriation. We have said in case we had interest on drawings, that one should be debited here. Salaries and commission to partners should be credited here. Then we have interest on capital should be credited here. So let's credit interest on capital here. So for John is 43.70. For Kelvin is 28.50. And basically for Renette is 18.80. Then we also have the share of profit, this one. So John is 16.850. Kelvin is 10.110. And Renette is 67 what? 67 what? So we are basically done with posting those items there. Now what is remaining is basically for us to balance this account. Okay, before we do that, there is something we are almost forgetting. Can we record the purchase consideration which is given in the last note? The last note, note number 5. Sorry, not note number 5, note number 1. In note number 1, you are told the purchase consideration on a business purchase was agreed at 150 million. Where do we record the purchase consideration which was agreed? The purchase consideration record in the business purchase account should be credited. The purchase consideration which was, and that is 150 what? Million. 150. I think basically we are done. So what is the remaining is for us to balance this particular what? Account. Now the first account which we have to balance is this one, the partner's current account. Partner's current account. Now this basically account shows the amount of money which the partners were entitled to receive from the partnership business. So the balancing figure from this account should be crossed off, should be transferred to this account. So that by the end of the day, we know the amount of money which each partner was entitled to receive. So the first account which we balance is this account here. Is this account here. So let's start by balancing this account here. And I've said the balancing figure will be crossed off to each account, will be crossed off to the partner's capital account. So how do we balance this account? We balance the current account for individual partners. So we will start with John. So we compare what we have on the debit and basically what we have on the credit. So I think on the debit side, we don't have any amount. What about on the credit side? In the current account of John, we have 14,790 plus 4370 plus 16,850. That's what we have on the credit side there. So we take what we have on the credit side minus what we have on the debit side. On the debit side, we have 0. So we should take 36,010 minus 0. So the balancing figure will be on the account. Here the balance carried out. No. So that balance I've said we transfer it to this account. So that balancing figure we transfer it to account, which is 36 That is 6.010. That is 6.010. Yes, getting to record drawings. Thank you. We did, sorry for that. Drawings we have 43, 70, 40, 20, and 29. What? Yes. So it before we get the drawings here, 43, 70, 370. The amount which we get here will be 31, 6 what? 40. Now we cross off this particular amount. We cross off this particular amount to which account? To this account. And basically we follow the rule of double entry. You can see this account is credited. Sorry, is debited, sorry. Then to complete the double entry, we need to credit this account. We credit this account. So we will say that there is an amount coming from the partner's current what? Current account. The amount from the current account of John is this one, 31 what? 640. So we do the same for the other partners. So Kelvin, we add what you have on the credit. Whatever you have on the credit side is what is more. 12,960 plus 2850 plus 10,110. That is what we have on the credit minus these ones. Minus this value here, 4020. And that will give us 21,900. We debit it here, we credit it here to complete the double entry. So we do the same for Inet. So for Inet, we have 9850 plus 1880 plus 6740 minus what you have on the debit, 2910. And basically I'm getting 15,560. 15,560. Are you getting those values? Is that what you're getting? Yes. So basically in our case, we are done with this account. This is now what was required there. That is what was required in the partner's what? In the partner's current account. Now, then next, what we need to do is basically we balance this account. Now, what you have said is that this account will be having a balancing figure, and the balancing figure in this account can either be on this side. If it is on that side, it is a gain on realization, and that has to be shared among partners using their profit and loss sharing ratio. If the balancing figure is on this side, is a loss on realization. Equally, it will be shared among partners and taken to the partners' capital account. If the balancing figure is on this side, it is a gain on realization. Yes, can we balance this account to see whether we have a gain or what? We have a gain or basically what? A loss. So let's add what you have on the credit, that is. Remember this basically what we did in the morning. So we will start with the material price variance. So we said what is important here is the formula. You have to remember the formula. How do we compute this? Anytime you see the variance, so this is caused by the difference between the standard, anytime you see the word price, this is caused by the difference between the standard price and the actual price. And then you multiply that with the actual quantity. I'm saying there is a question which we did in the morning and we made an error. I don't know whether you noted that. I think we used the standard quantity here, something like that. So can you go back to that question? You try to make that. The question we did in the morning, I think the last two parts, Roman 2 and Roman 3. I think we used the standard quantity. Sasa, it should be the actual quantity. Now let's check whether we have these particular values here. Do we have the standard price? The standard price, and remember here we are dealing with the materials. So what is the standard price of the material? So if we go to the information you have below paragraph 1, we're given the direct materials. We told the company requires 15 square meters, basically to produce 1 unit at a price of 30 shillings per square meter. So the standard price of material is 30 shillings, which is per square meter. And do we have the actual price? The actual price, this one can be given is actually below the last paragraph. Below the last paragraph, we go to where we have the materials. Direct materials were given 22,000 square meters at a price of 40. So 40 is the actual price. What about the actual quantity? Do we have the actual quantity? Yes. The actual quantity, 22,000 square meters. Sawa? Yes. So we move and we compute this variance. The material price variance, we take the standard price, which is basically 30 minus actual price 40, multiplied that with the actual quantity, 22,000. So this will give us, first of all, we said work out this, which is basically negative 10. So negative 10, negative 10 times 22,000. And basically that will give us 220,000. And we said because this is a negative, then this one will be adverse variance. Because it's a negative, it will be what? Adverse variance. It will be adverse what? Variance. Sasa? Yes. So that is it. We proceed and we move, we compute the other variance. The material usage variance. Now, this variance is computed by taking what? By taking the standard quantity minus the actual quantity, multiplied that with the standard rate. The standard what? Rate. The standard rate. Sasa, is that correct, Jeffa? Is that correct? Make sure you confirm to avoid making a mistake. That is correct. Zipporah, is that correct? Joseph, is that correct? Based on what you have? Is that formula correct? Should be very much correct. Yes. So basically, in our case, we already have this. We have the actual quantity. We have the standard rate. So maybe what is missing, oh, sorry. So this should be the standard, not the standard rate, standard price, sorry for that. Standard price, standard price, not rate. Yes. So in this case, what we are not given is automatically the standard quantity. How do we compute the standard quantity of materials? So we take the standard quantity per unit, standard quantity per unit, and then basically we multiply that with the actual production, production, or maybe the actual output. So this one is basically given below paragraph 1. How many square meters are required to produce 1 unit of this product? How many square meters are required to produce 1 unit of this product based on the information we have below paragraph 1? Can you give me this one? The standard quantity per unit. Standard quantity per unit. Standard quantity per unit. Standard quantity per unit is what? Materials required to produce 1 unit. Materials required to produce 1 unit. Materials required to produce 1 unit. Can I get that from each of you? You want to come at pamoja? Yes, this one should be 15 square meters. 15 square meters. That is now what is called the standard quantity per unit. We multiply that with the actual production. The actual production, we have it below the last paragraph. The actual production is 1400. 1400. We don't take the actual units which were sold, but basically we use the actual production. Actual production, the actual units which were produced, 15 times 1400. So this one will give us 21,000. Remember, these materials are measured in square meters. Yes. So having that, we can compute this variance, material usage variance, which will be equal to the standard quantity, 21,000, minus the actual quantity, this one, 22,000. We multiply that with the standard price. The standard price is basically shillings 30. Yes. So first of all, we work out this, and this basically will give us negative 1,000 times 30. So this one will give us what? This one will give us 30,000, which is equally adverse. Which is equally what? Adverse. Which is equally adverse. Which is equally adverse. Okay. So we are done with that. Basically, we can move to Roman 2. In Roman 2, we are required to compute the labor rate variance, the labor rate variance, and the labor efficiency variance, the labor efficiency variance. So Equally here, we require to compute the two types of labor variances. The two types of labor variances. We will start with the first one, which is basically the labor rate variance. The labor rate variance, this one is equal to the standard rate minus the actual rate, multiplied that with the actual hours, the actual hours which were basically paid, which were paid. So do we have the standard rate? The standard rate, this one, we have it below paragraph 1. For each hour which is worked, the company had budgeted to pay an amount of how much? As per the information we have below paragraph 1. The company was expecting to use 5 hours to produce 1 unit, and for each hour, the company was expecting to pay 100 shillings. 100 shillings is the standard rate. So then below the last paragraph, that's why we're given we go to where we have the direct wages, and we have the actual hours. Actual hours were 68, and then we have the actual rate, which is 110. So the standard rate 100, the actual rate is basically 110, and then the actual hours were 68. So we get the difference here, which is basically negative 10 times 68, and basically that will give us 68,000, which is equally adverse. Which is equally what? Adverse, because it is a negative. It is a negative. It is what? A negative. So we compute the other variance, and that is the labor efficiency variance. So this one is equal to the difference between the standard hours and the actual hours, multiplied that with the standard rate. The standard rate. Automatically here, we are not given the standard hours. The standard hours. How do we compute the standard hours? To compute the standard hours, we take the standard hours per unit. We multiply that with the actual production. The actual production. There are two items basically which I've said you'll not have been given the standard quantity and the standard hours. You have to compute that. So the standard hours, this one will be equal to this. So the standard hours per unit. Standard hours per unit, we have that below paragraph 1. Standard hours per unit. How many hours? Standard hours per unit. How many hours? Who can see that? The company had budgeted to use how many hours to produce 1 unit? As per the information you have below paragraph 1. How many standard hours? How many standard hours? Yes, the standard hours were 5. 5 hours. 5. We multiply that with the actual production. Actual production we know is 1400. 1400. Below the last paragraph, we multiply the 2, and this one will give us what? That one will give us 7,000. 7,000. Yes. So having that, we can finalize by computing this particular variance here. I hope you already have this. I want to create some space here. Aaron, what are you asking? 5 hours are for direct labor. Yes, that is basically direct labor. Ama kuna any other labor. So we only have one labor, Aaron. Or what should be the standard hours, Aaron? What should be the standard hours? It should be 5. 5. Sasa? Yes. So having that, we can compute this particular variance, the labor efficiency variance. We apply now our formula. We check the standard hours, which is basically 7,000. We minus the actual, sorry, this one should be actual hours. Mwalimu is mixing these items. Actual hours are 68. 68. And basically multiply that with the standard rate. The standard rate is the rate of 100. is the rate of 100. So we get the difference here, which is positive 200 times 100. And basically that will give us what? That will give us 20,000. 1, 2, 3, 4. 20,000. And because it's a positive, that is what? That is favorable. That is what? Favorable. So I think that is it. And basically, remember what I said is that, for example, for this particular variance, how will the marks be allocated? Here, the marks will be allocated for the formula and the answer. And the answer here. Sasa? Yes. Because we say these particular formulas in a MA, in a FEM, they are marked. So that's why you must get the formula correct. The formula has to be correct. Okay, so we are done with that. Then I want us to move to Roman 3. Roman 3. And basically, Roman 3, we are required to compute the fixed overheads, capacity variance, and the fixed overheads efficiency variance. Efficiency variance. So I've said these formulas may be many, but there is a formula you should not forget. For example, this variance, you should always get it correct, because I've said anytime you see efficiency, the cause of this is the difference between the standard hours and the actual hours. The standard hours and the actual what? Hours. And the actual hours. I hope you can remember the formula for this. Where do we have it? Fixed overhead efficiency. Fixed overhead efficiency. Standard hours, actual hours. Then you multiply that with this. The standard fixed overhead absorption rate per hour. So let's in fact start by computing this one. The fixed overhead efficiency variance. So this one is equal to the standard hours minus actual hours. Remember, you have these 2 hours, the actual hours and basically the standard hours. We multiply that with the standard fixed overheads absorption rates per what? Per hour. Absorption rate per hour. What do you mean by that? The standard fixed overhead absorption rate per hour. So this is basically the rate at which now these fixed overheads will be charged for each unit and also per hour. And also per what? Per hour. Where do we get this? We get this from the information we have below paragraph 1. Can we go back to paragraph 1? We go back to paragraph 1, where we have the standard costs. Where we have those particular standard costs, we are given 4 costs: direct material, direct labor, variable overhead. So we are interested with the fixed overhead. Now inside that bracket, we are given 5 hours at shillings 10 per hour. At shillings 10 per hour. Now that shillings 10 per hour is basically what you refer to this. That is the standard fixed overhead absorption rate per hour. Sasa? Yes. So the rate at which the fixed overhead is charged per unit and also per hour is shillings 10. Is shillings what? 10. So therefore this one is 10. This one is 10. This one is 10. Then we multiply that with the difference between standard hours and the actual hours. Remember, we already have that here. We already have the standard hours here and the actual hours. Sasa? Yes. So we don't need to compute that. So we just need to take what we have here, 7,000 and what? And 68. So we have 10, and then this one will give us 200, which is basically positive. That will give us what? 2,000, and which is favorable. 2,000, which is favorable. 2,000, which is what? Favorable. Sasa, you can see, provided you can be able to remember that formula, and you can be able to know this particular amount, the question is quite what? Simple. Then we go back and compute we compute the other variance here. That is a fixed overhead capacity variance. Fixed overhead capacity variance, fixed overhead capacity variance. Now, the fixed overhead capacity variance, I hope you can see we say that this one is caused by the difference. It's almost the same with this one. It's the same with this. It's the same with the fixed overhead efficiency variance. The only difference is that here you can see we're using what? Here we're using the budgeted hours, but here we're using what? The standard hours. We're using the standard what? The standard hours. The standard what? Hours. So the first thing maybe we need to compute here, or maybe to have here is the formula. And actually, we check the standard fixed overhead absorption rate per hour. We multiply that with the difference between the actual hours minus the budgeted hours. Minus the budgeted what? Minus the budgeted hours. The budgeted hours. So let's compute these budgeted hours. Remember, I've given you the formula for computing that. This is how we compute the budgeted hours. The standard hours per unit times the budgeted quantity. The budgeted quantity. The budgeted quantity is what the company had budgeted to produce and sell. Now, we already have this one, the standard hours. The standard hours are the number of hours the company was expecting to use to produce one unit. From the information we have below paragraph 1, we know the company had budgeted to use how many hours to produce one unit? 5. 5. That is the standard hours per unit. We multiply that with the budgeted quantity. So how many units were budgeted to be produced and sold? And I think I had explained that. Yes, the budgeted production is within paragraph 2, and that is basically 1,000. So this will give us 5,000 hours. 5,000 what? Hours. 5,000 hours. 5,000 hours. So having that now, we move and basically compute our variance. So we take this one, is basically 10. That one does not change. 10. We basically multiply that with the difference between actual hours. Actual hours, remember, are 68 minus the budgeted hours, which are basically 5,000. Now, for this particular variance here, if you can be able to call all the other variances we have computed, we have said, first of all, you need to get the difference here. Sasa, the difference here, if it is a positive, it is favorable. If it is a negative, it is adverse. But here, you need basically to consider what we are comparing. We are comparing the actual hours and the budgeted hours. The company used 6,800 hours. And the company had budgeted to use how many hours? The company had budgeted to use 5,000 hours. So you can see the company used more hours than what was budgeted. So if that is the case, you have used more hours in the production than what you had budgeted, then it basically means that that is adverse. That is what? Adverse. So therefore here, you will take 10, you multiply that with the difference, which is basically 18. But by the end of the day, because the company has used more hours than what was budgeted, then you do what? That one will be adverse. Alternatively, maybe to avoid cramming that, you may decide to interchange this. You start with the budgeted hours and then actual what? Hours. But essentially, that should be the formula for this. The formula which I've given you here. So this one will be 18. 18 what? Is it 18,000 adverse? 18,000? 18,000, how many? 1,800. 18,000, 18,000. 18,000. 18 what? 18,000. 18,000. 18 what? 8,000. 18,000. Yes. So basically that is it. That is what is required here. So there is another small question, but I think we will take a short breather, then we come back. So as we come back, make sure you have this question with you here. April 2024. April 2024, question 5A. April 2024. April 2024, question 5A. April 2024, question 5A. Question 5A. Question 5A. Yes. So I think we can take a short break. We come back and then we look on this other question here. So let's just take a short break of 10 minutes and then we come back. Continue. I hope you have the question with you. So let's go straight to that question. Let's go straight to that particular question here. Let's go straight to that question. So the question is, 𝐎𝐂𝐒𝐔𝐒 Limited uses the standard absorption costing, absorption costing in its operation. We are told the following information is provided by the cost accountant. We are given the actual information and also the budgeted figures. So we have the standard selling price, the variable overhead. Then we have the output and the sales. We have the total fixed overhead. We are required to compute 3 variances there. Number 1, you're required to compute the sales price variance. Number 2, the sales volume, profit variance. And number 3, we are required to compute the fixed overhead volume variance. So we are going to start with what is required in Roman 1. What is required in Roman 1? What is required in Roman 1? And basically in Roman 1, we are required to compute the sales price variance. The sales price variance. The sales price variance. Now, how do we compute this sales price variance? Remember, you have said that these are variance, which is occasioned by the difference between the standard price and basically the actual price. The actual price. So therefore, this one is equal to the standard selling price minus the actual selling price, multiplied that with the actual quantity which was sold. The actual quantity sold. And I think in our case, we have all these values here. So the standard selling price, this is like the budgeted selling price. The standard selling price is the budgeted. Sasa? Yes. So we're given the budgeted selling price. I hope you can see that below paragraph 1. So we have the actuals and the budgeted. You go to the column for budgeted. I've said that is the budgeted selling price is the standard selling price. So which is basically that one minus the actual selling price. The actual selling price is basically 26. We multiply that with the actual quantity sold. So below where we have that column for actuals, we are given the output and the sales. The output and the sales, which is 82. So this will give us what? First of all, we compute the difference here. So we have what? We have 31 and 26, which basically will give us 500. And then we multiply that with 82. 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 And after doing that, that is basically 82 times 500. Times 500. And basically this will give us 4.1. 4.1. Now, who can tell us, is this variance advanced? Is it favorable? This variance which you have computed here, is it advanced? Is it favorable? Advanced or basically favorable? Therefore, this variance here, adverse, I'm told is adverse. I'm told is adverse. I'm told by the Torah is adverse. Yes, so in this case, basically compare, you see, the company had budgeted to sell each unit at that 1. That is what the company had budgeted to sell each unit at. But the company sold each unit at a price of 26, a price which is lower than the budgeted. So if you sell your unit or a unit at a price which is lower than what you had budgeted to sell, that basically means that is adverse. That is basically adverse variance. That is adverse variance. So then from there, we compute the other variance, Roman 2, and that is the sales volume, profit variance. So remember, we have generally referred to this particular variance as the sales volume variance. But basically, I've said, depending on the method the company is using, marginal costing or absorption costing, the examiner basically will require you to compute either the sales volume profit variance or the sales volume contribution variance. So, and because in the first paragraph you're told the company is using absorption costing, that's why we are required to compute what? The sales volume profit variance. How do we compute this one? To compute this, we have said we take the standard profit per unit, per unit, and then we multiply that with the difference. With the difference between what? The difference between the budgeted sales and the actual what? Sales. So we basically multiply that with the budgeted quantity and the actual quantity. I hope that is the formula which we have there. Yes. So we multiply that with the budgeted quantity minus actual quantity, actual quantity. So I think in our case, we already have these two values here. Below the information we have, in the information below paragraph 1, we're given the output and sales, we're given the actual and budgeted. So we have actual quantity and the budgeted quantity. So what is missing is this one, standard profit per unit. So to compute the standard profit per unit, we will take the standard selling price per unit. The standard selling price per unit, we less the total cost per unit. The total cost per unit. But remember, if, for example, this company is using marginal costing, we automatically would have computed the sales volume contribution variance. And to compute, and actually the formula here would be standard contribution margin per unit. How do we compute the standard contribution margin per unit? We take the standard selling price per unit minus the total variable cost per unit. But here you can see we are taking the total cost per good per unit because we want to compute the profit. So in our case, we already have this one, the standard selling price. And I've said standard selling price is the same with the budgeted selling price, which is 31 minus this total cost per unit. Total cost per unit would be equal to which cost? Which cost are we given here? I think we're given the variable cost per unit, which is basically 1,000. And we take the budgeted or the standard. And then I think also you can see we're given the total fixed cost, the total fixed overhead. Now, automatically we can't add the total fixed overhead here because that is not per unit. So we have to compute the fixed overhead per unit, How do we compute the fixed overhead per unit? To compute the fixed overhead per unit, we will take the budgeted fixed overhead, which is 52,20,000, and then we divide this automatically with the budgeted quantity. The budgeted quantity is the amount which you have above this, which is basically 87. That will give us the fixed overhead per unit. So once we add it to that, we will get the total cost of producing each unit. Yes. So that now we can get now the profit per unit, the standard profit per unit. So this will give us what? 5220 divided by, that is the 52,20,000 divided by 87. And this will give us 600. I'm getting 600 there. We add it to 1,000, which basically give us 1,600. And then we less it from 31, which will give us the standard profit per unit of how much? Of 1,500. So that is the standard profit per unit. So having the standard profit per unit, we proceed and compute this variance. So we take the standard profit per unit, which is basically 1,500. We multiply that with the difference between the budgeted quantity, and the actual quantity. So the budgeted quantity is the 87. This is what the company had budgeted to produce and sell. And the actual quantity is 82. Is 82. Is 82. Is 82. Is 82. Is 82. We compute that variance. Give me the final answer here. Give me the final answer. Give me the final answer here. You give me the final answer. The final answer, you're getting what? I'm given 750. Is it adverse or favorable? Adverse or favorable? Adverse or favorable? Yes. So this one I'm given 750,000. 750,000. Basically, you can see the company, whatever you have here is budgeted quantity. And basically, whatever you have here is actual quantity. So the company had budgeted to sell 87, but the company only managed to sell 82. So the company sold less than what it had budgeted. So automatically that one will be what? That one will be adverse. That one will be adverse. That one will be adverse. So we move to the other variance. We move to the other variance. We move to the other variance. Roman 4, Roman 3 that is. And we are required to compute the fixed overhead. The fixed overhead volume variance. The fixed overhead volume variance. Remember, in the other question, I think which we have done, I think we have computed this one. And actually, you have said that to compute the fixed overhead volume variance, this one. Yes, I think we have not computed this one. We have computed these two. So we take the standard fixed cost per unit. And I think we have already computed this. The standard fixed cost per unit. Can you remember this? Who can be able to remember this figure? The standard fixed cost per unit. Standard fixed cost per unit. In other terms, that is the same as the budgeted fixed cost per unit. The budgeted fixed overhead per unit. Who can be able to remember that figure? You have computed it. You have computed that somewhere. Who can be able to remember that figure? Standard fixed overhead per unit. Yes, that's basically what you have computed here. That is what we have computed here. The budgeted fixed overhead per unit. Per what? Per unit. So basically, we multiply that with what? With the budgeted quantity minus the actual quantity. Minus the actual quantity. So this one is basically 600. 600. We multiply that with the budgeted quantity. Budgeted quantity is basically 87. 87. And then the actual quantity is basically 82. Is 82. So we compute that particular variance. That variance there. So we have 87 minus 82, which will give us 500. So we have 600 times 500 times 600. And basically, this will give us 300,000. 300,000. Is this adverse or basically favorable, adverse or favorable, adverse or favorable. I'm told it's favorable by Zipporah. I'm told it's favorable. Favorable or adverse. Budgeted quantity, 87. And the actual quantity is what? Is 82. Adverse or favorable. Remember this basically a cost. Remember this is a cost. What is that? Is that adverse or favorable? Adverse or favorable? Adverse or favorable? Adverse or favorable? So this one will be, this one is basically adverse. This one is what? Is adverse. This one is adverse. Why is it adverse? Why is it adverse? Why is it adverse? So I hope you can see the budgeted quantity. So the company basically had budgeted to produce and sell basically 87, but the company produced and sold how much? How many units? 82. So that basically why we are saying it is adverse. It is basically adverse. It is adverse variance. So I think that is it. Then we have so many questions actually in relation to this. So many questions on variances. So many questions on variances. Maybe let's do the last one. Let's do the last one. You can see we have 20 minutes. We can do a question with maybe which we can be able to finish within that time. Though we will also come back to this during our revision, because I said that this is an area I'm expecting that it should be examined this sitting. There should be a question on this. There should be a question on this. There should be a question coming from this. So we have this question for April 2023. April 2023. Question 5B. Question 5B. So let's go to this one, and we will try to hurry up because of time. I want us we finish this question here within 20 minutes. Within 20 minutes we should be done. Within 20 minutes we should be done. Yes, I hope you're on it. I hope you have that question with you. I hope you have the question with you. I hope you have the question with you. So if you have the question, please confirm. Please confirm. Yes. So what are we told here? The question reads, that is part B. Dex Limited manufactures a single product branded 𝐎𝐍. The company operates a standard marginal costing system. The following information for the month of March 2023 is available to you. Number one, you're told the budgeted production and sales for the month amounted to 6,000 units. Number two, the standard selling price of product 𝐎𝐍 per unit is 13,200. Number three, the variable standard manufacturing cost per unit are as follows. So we have the direct material, we have the direct labor, variable production of items, and then we are given number four, where we are told the actual results for the month of March 2023 were as follows. We're given the actual results there. The actual production, the actual output, the sales, the direct material, the direct labor, the variable files, the variable production of files are absorbed on the basis of direct labor hours. Number six, we are told the opening and the closing inventory of finished goods are valued at the standard variable manufacturing cost per unit. What are we required to do? We are required to compute a number of variances there. So we start with the first variance. And basically that is the sales price. Automatically that should be the sales price variance. the sales price what? Variance, the sales price variance. How do we compute this particular variance here? How do we compute this variance? I've said we take the standard selling price minus the actual selling price. We multiply that with the actual quantity which was sold. The actual quantity which was sold. That is basically the formula. So do we have the standard selling price? The standard selling price is given, where do we have that? We have that in note number 2. In note number 2, you're told the standard selling price of product XV is 13,200. The standard selling price, 13,200. Then we minus the actual selling price, which we have in note number 4. And actually, the actual selling price is not given because what we are given the actual units which were sold and the sales in the total sales. So to compute the actual selling price, we will take the actual sales which were made by the company, which is 87,075. And I hope you can see those values are in thousands of shillings. We multiply that with the actual quantity. With the actual quantity sold, 56 what? 40. So that is basically how we get what? We get the actual selling price. We multiply that with the actual quantity sold. This is the actual quantity sold. 54 what? 60. 54 what? 60. So let's work out the actual price, actual selling price, which is basically 81,075. 075 divided by 5640, and that will give us around 14,375. So we have 13,200 minus 14,375. We multiply that with 5640. So that will give us what? So we get the difference here. And basically that will be 1175 times 5640. And that will give us a final answer of what? A final answer of 66,27,000. Then we need to indicate whether that variance is adverse or favorable. But first of all, confirm whether you're getting that value. Are you getting that value there? Are you getting that value there? Confirm whether that is what you're getting. Yes. So now, is that adverse or favorable? Adverse or favorable? Adverse or favorable? Adverse or favorable? So standard selling price, the company had was expecting to sell at this, but the company sold at a higher price. At a higher price. What is that, Vipora? Is that favorable or adverse? Adverse. Adverse. So you have said that this selling price. So company requirement target kuuza 13,200 each unit, but the company sold 14 at 14,000. This one is favorable. This one is favorable. Sasa, yes. So Roman 2, Roman 2, the sales volume contribution variance. Contribution what? Variance. Remember in the other question, we have computed something called the sales volume profit variance. But now, because this company is using marginal costing, that's why we are required to compute the sales volume contribution variance. Sasa, yes, there is somewhere we are told this company uses marginal costing. Where do we have that information? We have that information within the first paragraph, the last sentence. We are told the company uses standard marginal costing system. Standard marginal costing. So therefore, to compute this, we will take the standard contribution margin, standard contribution margin per unit, standard contribution margin per unit. It will cost the company 422, that is 42.25. That is the cost of material to produce one unit. And then we add the direct labor cost, which is 23.50. That is still a variable production cost. And then we add the variable production overheads, which is 16.75. Now that will give us what? That will give us the variable production cost per unit. Variable production cost per unit then will be 82.50. I hope you can see I've added three costs. I've added direct material, direct labor, and the variable production of items, which is basically given below paragraph in note number 3. In note number 3, I hope that is what you're getting. Then you multiply that with the difference between the budgeted quantity, the budgeted quantity. Budgeted quantity, we have this in note 1. Note 1, 6,000 minus the actual quantity. Actual quantity is, this should be the actual quantity sold, not produced. Actual quantity sold. The actual quantity sold, we have this in note number 4, the units which were sold, not the ones which were produced, but the units which were sold. And basically that is 56 what? 40. 56.40. So this will give us what? So this will give us 49.50. We multiply with this difference, 6,000 minus 56.40, and basically that will give us 36. So then we multiply the two, 49.50, and basically that will give us 17,82,000. 82,000 advance, or is this advance or is it favorable? Advance or favorable? The company had budgeted to sell 6,000. The company only managed to sell 56.40. Advance or favorable? Advance or favorable? Is that advance or favorable? Advance or favorable? Yes, this one should be advance. The company sold less than what it had budgeted to sell. So that is advance. So we move to Roman 3. We require to compute the direct material price variance. Direct material price variance. In other terms, what you require to compute here is the material price variance. The material price variance, which is equal to the standard price of the material minus the actual price of the material. Actual price of the material, we multiply that with the actual quantity. And actually now this one should be the actual quantity, or basically instead of actual quantity, can you talk of actual output? Because you can see there, in case of quantity, there, like this question, we're given the actual quantity produced and the actual quantity sold. What do you use here? The actual quantity produced. But now the actual quantity produced, just talk of the actual output. Sasa? Yes. So to avoid being confused of which actual quantity you are going to use. Is it the actual quantity produced or is it the actual quantity sold? But once you use the word actual, oh, sorry. Oh, Modimo is moving very fast. So this one should be the actual quantity. Remember this should be the actual quantity for the material, sorry. I think I'm confusing this with the computation for the standard quantity. Sorry for that. Should be the actual quantity. Okay. So do we have the standard price? Yes, standard price is given in note number 3, standard price. Standard price, we go to where we have materials. So we are told materials, the company required 2.5 kgs to produce 1 unit. The standard cost is 1690. 1690 is the standard price. The actual price, this one has to be given in note number 4. Actual price of the material is not given. So, but we have to compute that. So to compute that, we will take the actual, actual total cost of materials, 27,987, and basically that is in thousands. And then you divide that with the actual quantity of the materials, 14,730. That will give us the actual price. We multiply that with the actual quantity of the material purchased, which is basically 14,370. 14,730, sorry. 14,730. Yes. So let's work out this. We have 27,987,000 divided by 14,730. 730. Yes, are you getting some decimals there? So we have 27,987,000 divided by 14,730. Yes, now it should be 1900. Should be 1900. So we have 1690 minus 1900 multiplied with this 14, 7 what? 730. Sasa? Yes. 730. Okay. So we get the difference here, and automatically this one will be a negative. 1690 minus 1900. So that is a negative 210 times 14. Yes. So automatically that would be adverse variance. So that is the adverse 30, 93, 300, which is adverse, which is adverse, which is adverse. So we move to the other variance, number 4, and that is the direct or direct material usage. Direct material usage variance. So how do we compute this one? We take the standard quantity minus the actual quantity. We multiply that with the standard price. We multiply that with the standard what? Price. So definitely in our case, I think we have this. We have the actual quantity, which is basically this one. We have the standard price in note number 3. What you're not given is the standard quantity. Standard quantity, I've seen this one, is not given in any question. So we compute this by taking the standard quantity per unit. Standard quantity per unit. Per unit, we multiply that with the actual production. So basically, I was confusing this with what we have here, actual production. Actual production. So the standard quantity per unit, in the information you have in note number 3, standard quantity required to produce 1 unit is 2.5 kgs. That is the standard quantity per unit. We multiply that with the actual production in note number 4, the first item, 63.8. That will give us the standard quantity. So the standard quantity here, we have 2.5 times 63.8, and basically that will give us 15,950. So the standard quantity of material. So our variance here, that is the material usage variance, will be equal to the standard quantity 15,950 minus the actual quantity. Actual quantity, we have it in note 4. Actual quantity of material is 14,730, and that is also what you have used there. We multiply that with the standard rate. The standard rate, we have it in note number 3. So what is the cost of the materials? Sorry, standard price, not standard rate, standard price. Standard price, which is basically 1690, standard price per kg. So we get this difference, which is basically a positive times 1690. And that will give us 2,061,800. And basically these are positive, meaning that this one is favorable. This one is favorable. So we are done with that. Let's move to number 5. We are required to compute the direct labor rate variance. The direct labor rate variance. So in this case, in other terms, we are required to compute the labor rate variance. The labor rate variance. How do we compute the labor rate variance? We take the standard rate minus the actual rate. We multiply that with the actual what? With the actual hours. With the actual hours. The actual hours. So the standard rate, this one should be in note number 3. Standard rate is 1880. 1880. The company had budgeted to pay shillings 1880 per hour. What about the actual rate? Actual rate should be note number 4. Are we given the actual rate? No. So, but we need to compute the actual rate by taking the actual direct labor cost, 363,000, we divide that with the actual hours. 85, 35, 85, 35. That will give us the actual rate. We multiply that with the actual hours which were paid. That is 85, 35, 85, 35, 85, 35. So this will give us what? We have 15, 63,000 divided by 85, 35. So that will give us 18. So we have 1880 minus 1800, multiplied that with 85, 35, 85, 35. So this will be 80, which is basically positive, times 85, 35. So that will give us 682, 800, which is favorable because here we have a positive figure. We have a positive figure. So finally, number 6, we are required to compute the direct labor efficiency variance. Efficiency variance. I've said anytime you see the word efficiency, just know that this variance is occasioned by the difference between the standard hours and the actual hours. So therefore, to compute this one, we take what? We take the standard hours minus the actual hours. We multiply that with what? We multiply that with the standard what? Rates. The standard rate. So I think we have the standard rate, this one. We have the actual hours. What is missing is the standard hours. Standard hours, just like the standard quantity. This one, the examiner will never give you this one. You have to compute it. We will take the standard hours per unit. We multiply that with the actual production. The actual production. So the standard hours per unit is, we have this in note number 3. How many hours are expected to, how many hours are, does the company expect to take to produce 1 unit? Is 1.25. 1.25 hours per unit. We multiply that with the actual production in note number 4, which is 6830. Yes, that will give us the standard hours. The standard hours. 1.25 times 6380, and this will give us 7970. We start with the question for August of 2022. August 2022, and this was question number what? This was question number 4. Question number 4. So if you are here, please confirm. If you have the question with you, just confirm. Just confirm. Just confirm. Just confirm whether you have the question. Yes, confirmed by Elizabeth. Confirmed by Patrice. Okay, so what are we told as far as this question here is concerned? What are we told here? So the question is, Tagga Limited is a private company, private limited liability company operating in telecommunication industry. The company has been has suffered successive trading losses for a number of years, largely due to stiff competition. Yes, Raphael, I'm recording. Largely due to stiff competition and a sharp decline in the revenue. So we are told the directors of the company, who are also the main shareholders, agreed to restructure the company by transferring it to a new company to be named 𝐓𝐿 Limited. So automatically, this is an external reconstruction because this company, which is called Tagga, we are told it will be restructured by transferring its business operation asset and liabilities to a new company, which is called 𝐓𝐿 Limited. So then you're told the statement of financial position of Tagga Limited as at 30th of June 2022 was set out below. So we're given the statement of financial position of that company before the reconstruction. We have the non-current asset, current asset. We have equity, non-current liabilities, and current liabilities. Then we have additional information number 1 or the note number 9. And basically, if we go through this particular note here, whatever you're given in note 1, note up to note 9. And basically, you compare with the other question which we did, you'll be able to see the notes are almost the same. The notes are almost the same because I say these questions for external reconstruction, they are the same. So the examiner will just try to change very few items, but essentially the questions are the same. So what are we required to do here? Part A, we are required to prepare the following ledger account to cross off the books of 𝐻𝐿 Limited. Roman 1, the realization account. Roman 2, ordinary shareholders sundry members account. Roman 3, the preference shareholders sundry members account. And then part B, we are required to make the journal entries in the books of account of 𝐻𝐿 Limited to record the acquisition of Tanga. If you can remember the other question which we did, the examiner was not requiring the student to make those journal entries. And then part C, we are required to prepare the opening statement of financial position of this company, of the new company, as at 1st July 2022. So remember what we say is that once you come across such a question which the new company is supposed to pay the shareholders and the financials of the old company. Number 2, cross off the books of account, books of what? Old or the selling company. Of the old or the selling what? Company. Now, after doing that, like this particular question here, you have now to proceed and you make the journal entries. The journal entries to do what? To open the books of account, to open the books of accounts of the new company. The new what? A company. And then finally, you prepare the statement of financial position equally for the new what? A company. Essentially, these are the steps you should follow. But we said in an examination setup, I will not advise you to compute this because if you can remember the question we did yesterday, I think you can be able to recall how computation of the purchase consideration was demanding and also it is time consuming. So therefore, if you happen to come across this question in an examination setup, avoid computing this. Even without having computed that, you'll be able to get good marks, basically over 15 marks, without having computed that purchase consideration. So what we need to do basically, we will go straight to crossing off the books of account of the selling company, basically by preparing the relevant ledger accounts. So those are the ledger accounts we require to prepare in Roman 1, the realization, ordinary shareholders sundry members account, the preference shareholders sundry members account, to cross off the books of account of the old or the selling company. Then from there, we're going to make the journal entries for the journal entries to open the books of account of the new company. And finally, we prepare the statement of financial position of the new company. We'll be able to see that by using that particular approach, that question, you should be able to do it within 30 minutes. You have more than 15 marks, you move to the other question. So therefore, you move to this one to cross off the books of account of the old company. But before you do that, it is important for you to recall what you're told in paragraph 1. The company which is to be restructured is 𝐻𝐿. This is a company which has been making losses, and this is the company which is to be liquidated. Its business operation, assets, and liabilities taken over by a new company, which you're told will be known as 𝐿𝐿 Limited. 𝐿𝐿 Limited. So therefore, this is the selling. In other terms, this is the old company, whereas this is the new. In other terms, we refer to this as what? As the purchasing company. As the purchasing what? A company. So the first thing we need to do basically is to cross off the books of account of 𝐻𝐿. And we do that by preparing the ledger account we are required to prepare as per Roman 1 of that word question. So we move to, or basically we go straight to Roman 1 of the question. And we are required to prepare the relevant ledger account to cross off the books of account of Tanga. So part A of the question, ledger account to do what? To cross off books of accounts of who? Of Tanga Limited. So which ledger account do we prepare? The ones which are listed there. With the realization account. The realization account. Then from there we will prepare the other ledger account, which is called the ordinary shareholder sundry members account. Ordinary shareholders sundry members account. Sundry members account. So we don't have so many entries which we record here. And then from there, Roman 3, we require to prepare the preference. The preference are shareholders sundry members account. Sundry members account, the preference shareholder sundry members account. Yes. So basically, we said what we just need to recall is what we record in each of these accounts. And actually, we said when crossing off the books of account of the old or the selling company, what we do, we go back to the balance sheet, to the statement of financial position of this company. And basically, we have to cross off all those particular accounts which had balances and whose balances are shown in the balance sheet or in the statement of financial position. Can we go back to the statement of financial position of this company? The information which we have, or actually the statement of financial position. Now, what we said, we start by crossing off the asset account. You can see under the non-current asset, we have two assets. We have property, plant, and equipment, goodwill, and then current asset, we have inventory, trade receivables. Now, we said if you go to the additional information, you'll be able to see somewhere being told, or basically you'll be able to see a note whereby you are told, you are given information about the assets which were transferred to the new company, and those may be assets which were written off. Usually, or in our case, that is in note number 6. Even without reading all the notes, I can see that in note number 6. Can we see, go to note number 6? We are told the tangible assets were transferred to the new company at the following fair values. Which assets were transferred? They include property, plant, and equipment, inventory, trade receivables, and then you're told goodwill was considered valueless and it was written off. So therefore, we go back to the statement of financial position. We have 4 assets, 2 non-current assets and 2 current assets. We know the PPE, inventory and receivables were transferred to the new company. Goodwill was written off. Now, what we said, those particular assets which were taken over or transferred to the new company, we debit them here at the book values. The book values are the values we have in the statement of financial position. But it's also important for us to indicate that our values will be in thousands of shillings. So the assets which were transferred to the new company include the PPE. What is the book value for that? Remember, we said we use the book value or the carrying amount. The book value or the carrying amount are the values we have in the statement of financial position. Not the values we have in note number 7. The values we have in note number 7, we are going to use them when opening the books of account of the new company. Sasa, very important. So the book value for this is 59,500. 59,500. Then below that, we have goodwill. Goodwill is an asset which has been written off. We said those assets which are not transferred to the new company and they are written off. Basically, those assets are supposed to be debited in this account, not the realization, but the ordinary shareholder sundry members account. Goodwill was written off as per note number 7. The value for that is 9,000. So then from there, we go to where we have current assets. The 2 current assets as per note number 6 were transferred to the new company. We debit them here at the book value. The book value are the values we have in the statement of financial position, 18,500. And then this one, the trade receivables. The trade receivables is what? Is 14,500. So basically, we are done with the assets. We are done with the asset. So when we say don't skip anything, because for the asset can either be transferred to the new company or written off. Those assets which are transferred to the new company, you debit them there at the book value. Those assets which are written off, debit them there at the book value. Then from there, we go to the equity. So for the equity, we have the ordinary share capital. Ordinary share capital. Just a minute. Yes, so we continue. So basically, I've said we are done with the assets. We go to where we have equity. So equity, we start with the first item, which is ordinary share capital. Ordinary share capital, we say is crossed off to this account and actually should be credited. Ordinary share capital. So ordinary share capital, basically it should be credited here. And that is basically an amount of 60,000. So then below that, we have 9% cumulative preference share capital. Preference share capital will be crossed off to that account and equally should be credited in this account. It should be credited in this account. It should be credited in this account. The 9% cumulative preference share capital, and that is an amount of how much? Is an amount of 30,000. Then below that, we have share premium. We said any form of any reserve should be crossed off to this account. Share premium and any other reserve, that one should be crossed off to this account. It should be credited here. Basically, we have 30. And then below that, we have accumulated losses. Accumulated losses is still a reserve, but that one, because it's a negative, it should be recorded on this side. Should be recorded on what? On that side. On that side, the accumulated losses. The accumulated losses. How much are the accumulated losses? 27,400. 27,400, like such. So I hope you can see we are done with the items of equity. Then for the items of liabilities, we have the bank loan and the current liabilities. So we must be given some information in relation to this. In most of the cases, we say liabilities, unless otherwise, they are transferred to the new company. We must be given some information in relation to that. Like if you go to note number 7 in our question here, we are told the liabilities are non-current and current. The liabilities were taken over by the new company at their book value. So all the liabilities, the non-current and current, were taken over by the new company. So the liabilities which are transferred to the new company, we say they are credited here. They are credited here. We start with the bank loan. We start with the bank loan. So the bank loan is basically 22,500. And then we have the trade payables. The trade payables, which is basically 59. Then we have the tax payable. The tax payable, which is basically 3,000. We have the bank overdraft. The bank overdraft, which is 40, which is 45, which is 45. Now you can see what we have done. First of all, we have crossed off all the accounts which had balances as per the statement of financial position, which is given there. Now, there are two other items I think we said we must always remember to account for here, because the other item which we should compute or basically credit here is the purchase consideration. But I've said don't bother yourself computing that. Ignore that purchase consideration, because if you happen to compute that, you'll consume a lot of time doing this question. It's not a must you have to compute that. You'll be able to get good marks even without computing this. Now, the two items you should always remember to account for is, in all questions for external reconstruction, you'll be told this company which is being restructured had not paid preference dividend for a number of years. So what you need to do, you need to compute the preference dividend in arrears. So this one must be given somewhere in the additional information. You just need to go through those particular additional information. There must be somewhere you're told you're given that information. Where do we have that? I can see it in note number 4. I can see that in note number 4. We are told the preference dividend in Tanga were 3 years in arrears, and the preference shareholders, in fact, we can just ignore that. We just need to know the preference dividends were in arrears for how many years. We are told the preference dividends were 3 years. Information is basically for computing the purchase consideration, which you have said we need to ignore. So the preference dividends in arrears, we are told they were 3 years in arrears. How do we compute the preference dividends which were payable by Tanga? We are going to use this information about the preference share capital. The company had issued 9% preference shares, meaning the preference dividend to be paid each year would be 9% of this. That will give us the preference dividend per annum times what? Times 3 years, because they were in arrears for 3 years. Yes, that basically gives us the preference dividend in arrears for how many years? For 3 years. So let's work out this. So we have 9% times 30,000 times 3. And basically, we are getting what? We are getting 81. So how do we account for these preference dividends in arrears? The preference dividends in arrears, we said they are debited here in that account, and then we credit them in this account. The preference dividends in what? In arrears. 81. 81. The other item we should also remember to account for is to debit the liquidation cost here. The liquidation cost which was incurred in liquidating this company and paid by the old company should be credited here. You should also be given that in the additional information. Let's go to the additional information number 5. I can see it somewhere in note number 5. And you're told the liquidation expenses of Tanga amounted to 8 million and was basically settled by Elewa. So there was a liquidation cost of 8 million. Now, these are the two additional items you should always to remember to account for, and which are not given in the statement of financial position. Now, once we are done with that, you leave, or basically in our case, we are done with the part A. We are done with part A. Basically, that's what you should do in relation to part A. And now, if that question you leave it at that point, you'll be able to see that you can only maybe lose 1 mark or maybe 2, even if we have not computed the purchase consideration. Because, for example, in terms of how this account is marked, this is now the items which will be marked 1, 2, 3, 4, 5, 6, 7, 8, 9. How many marks are allocated here? The marks allocated here are 8. So the minimum marks you can be allocated. In fact, this is how this account is marked. Any marks allocated here for any 8 at half. Any 8 at half. Any 8 at half. Any 8 ticks. Each tick you get what? Half. It basically means that you need to get 8 ticks here. How many ticks do we have? We already have more than that. 1, 2, 3, 4, 5, 6, 7, 8, 9. So we already have 4 marks there. 4 marks there. Now this one is basically marked like this. Any 4, because the marks are located here at 4, any 4 at 1. Because I think just 2 items which are missing here, the purchase consideration and the realization gain or loss. So 1, 2, 3, 4. You can also see here, we already have 4 marks. And this account also is marked any 2 at 1. So I can be able to share with you the marking scheme. You can be able to see. So in that case, you can see we already have 2 entries. How many marks are located there? 2 marks. You can see within 10 minutes, you should be having those 10 marks with you. You should be having those 10 marks with you. Now, once we are done with that, we need to move to the other part of the question, and that is part B. Part B. So what are we required to do in part B? In part B, basically we are required to make the journal entries to do what? To open books of accounts. Books of accounts of who? Of the new company. Remember, the new company is called what? Elewa Limited. So we are required to make the journal entries to open the books of account of the new company. Remember, you said that if we are required to make the journal entries, now, Odiek is asking about, now remember the other question we did yesterday. Now, the double entry for this liquidation cost is debited here, and then the other entry should be in the purchasing company account. Check the other question we did, but you can see we are not required to prepare the purchasing company account. Are we required to prepare that, the purchasing company account? No. So that's why we are not completing that double entry. Sasa? Yes, we are not completing that double entry. But in case it was required, then you have to prepare that and then you credit that amount in that account. Sasa? Yes. So let's make the journal entries. Now, when making the journal entries here, you make journal entries basically for a number of items, which are obvious. So number 1, account for the assets which are taken over. Number 1, make a journal entry for the assets which are taken over at the fair value. Number 2, account for the liabilities. For the liabilities taken over, liabilities are taken over at the book value. Number 3, account for the liquidation cost which was paid. Now, by basically accounting for these 3 items, you'll be able to score also all the marks here. So account for those 3 items: asset taken over, liabilities taken over, and the liquidation costs which were paid. Don't even bother going through the additional information there, because you can see, we know the assets which were taken over, we know the liabilities which were taken over, we know the liquidation cost which was paid. But maybe you can also peruse through, you see whether there is anything you can account for. For example, I think in note number 8, we can see whether we can make any journal entries here. But basically, let's make a journal entry for those 3 items. One, we will account for the assets taken over. So we can say asset, instead of giving a narration, we can say what we are accounting for here, an asset taken over, the asset taken over at the fair value, So how do we account for this asset which are taken over? Remember, we are doing a journal entry. We are passing a journal entry. Automatically, once the new company takes over some asset, those assets should be debited in the respective asset account. And then credited in the account called business purchase account at the fair value. So the assets which were taken over by our new company, we have those assets in note number 6. So the assets which were taken over, number 1 is the PPE. So we are going to debit, that one will be debited in the PPE account. PPE account at an amount of 55. Remember, values here are in thousands of shillings. So we debit PPE. Then we, the other asset which was taken over is basically inventory. That we debited in the inventory at an amount of 2,200. So then from there we have the other asset which is basically trade receivables, which is an amount of 14,500. Yes, basically I think those are the 3 assets from what we have here which were taken over. But there is something also you must be able to recall. If you can remember the question which we did yesterday, we say that once this liquidation cost, which is incurred by this company, we say it is always paid by the new company. Now, once the new company pay for that liquidation cost, in some questions, not all, you can be told that the new company decided to account for that as a preliminary expense. So if it decided to account for that as a preliminary expense, it basically means that this company capitalized that particular cost, and therefore it recognized that as an asset. And what we say, therefore, you need to recognize that here as one of the assets which was inherited, one of the assets which was acquired from the old company. So what we need to do is to check whether this particular preliminary, this liquidation cost, was it recognized as a preliminary expense? So let's go to the information which we have in note number 6. We are told, note number 5, we are told the liquidation expense of Tanga amounted to 8 million and were settled by 𝐻𝐿. Is there anywhere we are told that this particular cost was to be capitalized or it was to be treated as preliminary expense? Are we given that information? Yes or no? Are we given that information? No. But if we were given that information, then we include it here as one of the assets which was inherited from the old asset. That's yes. So then with the total amount, we credit the business purchase account. So with the total value of the assets which were taken over. So we have 55 plus 2,200 plus 14,500. So this will give us 89,700. Remember, we have already explained there above. We have already explained here what we have accounted for. What we have accounted for are the assets which were taken over. Number 2, we account for the liabilities which were taken over. Liabilities taken over. Remember, the liabilities we said are always taken over at the book value, because we said liabilities are not revalued. We say you cannot revalue a liability. For example, you can see that this company had a bank loan. There is no way you can revalue a liability. There is no way you can do what? Revalue a liability. So how do we account for these? How do we account for these liabilities which were taken over? So what we do is that we debit the business purchase account, we credit the specific liability account. So in our case, from the realization account which we have here, we know that we have how many liabilities were taken over? 4 of them. These liabilities. So we will debit the business purchase account. We will debit the business purchase account. And then we credit the liabilities account. So we have the bank loan. We have the trade payables. We have the trade payables. We have the tax payables. And then we have the bank overdraft. The bank what? The bank overdraft. So let's first of all, we credit those accounts. So the bank loan was, the bank loan is 22,500. The trade payable is 59. And then the tax payable is 3,000. The bank overdraft is what? Is 55, is 45. That is 45. Then we need to get the total and we debit it in the business purchase. So 22,500 plus 59 plus 3,000 plus 45. And basically that will give us 35. 900. So what have we accounted for here? We have accounted for the liabilities which were taken over. Now then from there, we also have this, and this is something you'll come across in all questions, the liquidation cost, which was paid by the new company. So make a journal entry for that. Liquidation cost, which was paid. The liquidation cost which was paid. A liquidation cost which was paid. Now, this liquidation cost, the liquidation cost which was paid, this one, number one, should be credited in the bank. Should be credited in the bank. And then from there, we debit an account called what? The selling company account. So the selling company, remember, is the old company. That should be the journal entry. So we debit the selling company. Remember, the selling company is the Tanga Limited. So account. How much is the liquidation cost? The liquidation cost is 8,000. 8,000. And then we credit the account which is called what? The account, or basically we credit bank. Remember, this amount was paid. We credit bank. We credit what? Bank. We credit bank. Now, once you make those journal entries, I think you can just leave it at that point. Just leave it at that point. How many marks are allocated there? The marks allocated there are 6. So basically, these what will be marked 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So the minimum marks you can be given per entry can be half. So meaning that you're required, for example, for you to get 6 marks, you need 12 ticks, each half, and you get what? 6 marks. How many ticks do we have here? We have 11. So you'll get 5.5. To the nearest whole number, that would be 6. To the nearest whole number, that will be what? That would be 6. It basically means that by doing that, you already have all the marks. You already have the 60. Now, then from there, we proceed and basically prepare what is required in Part C. Part C. Can you see how simple this question is if you use that particular approach? Can you see how simple this question is basically to get those particular marks? Very, very simple. Very, very simple. So you can see already we have 10 marks here. We have 6. So we already have how many marks? We already have 16 marks. So then from there, we basically prepare what is required in the last part. In the last part, that is the statement of financial position. Opening statement of financial position. Position is at 1st of July. 1st of July 2022. 1st of July 2022. Now, equally here, I think we have so many marks which are free because, like, we know which assets were taken over. So all those are basically free entries. Here, we just need to to post them here. So we just need to have a single column pair. We start by recording the non-current assets. So the non-current assets, we record the assets which were taken over from the old company, from the selling company. And remember, you see that we record those particular assets here in the books of accounts of the new company at the fair values. So these are the assets which were taken over here. So we start with the PPE, property, plant and equipment. This was taken over at a value of 55. Maybe the other item you can also include here is the preliminary expense. If the liquidation cost, which was paid by the new company, was capitalized, or in other terms, it was treated as a preliminary expense, also included there. But in our case, you can see it was not treated as preliminary expense. Then from there, we move, and basically we record the current assets. Now, for the current asset, I think we have these two. Inventory. Inventory basically is this value 20,200. What about receivables? And receivables, basically that one will also not change. 14 what? 14.5. Automatically here we may have other assets like the bank balance and so on, but no need of even computing the bank what? The bank balances. No need of even computing what? The bank balances. Then from there we move and basically record what? Record equity. Now for equity, I think we can be able to get this because in note number 1, can we go to note number 1? We are told that the ordinary share capital of 𝐻𝐶𝐒 Limited, which is the new company, is shillings 100 million. That is the ordinary share capital, comprising of 10 million shares of shillings 10 each. So then, basically what we know is that some of the shares were issued by this company to pay the purchase consideration. There is some information which we have in note number 8. Note number 8. In note number 8, we are told 𝐻𝐶𝐒 Limited, which is basically the new company, issued for cash and at par all the remaining ordinary shares not issued as part of the purchase consideration. The proceeds from the issue were used to pay the bank loan. So the bank loan will not appear here because you can see it was paid. But in this case, can we be able to compute the ordinary share capital of the new company? Yes. The ordinary share capital of this company will be equivalent to the registered, because we are told in note number 8, those shares which were not issued by the company to pay the purchase consideration, all of them are issued for cash and at par. So basically what that means is that the share capital of this company will be equivalent to the registered share capital as per note number 1. The registered share capital of this company as per note number 1 is 100 million. Is 100 what? Million. That will be the share capital. Then from there, non-current liabilities. Non-current liabilities. So this company, I think the obvious non-current liability we can have is the bank loan, but basically we are told this bank loan was paid. It will not appear here. It will not appear here. Then from there, we record the current liabilities. Now for the current liabilities, we have these current liabilities which were taken over, 3 of them. So automatically this bank overdraft was paid because there was money which was received. So that one was paid, the bank loan was paid. Maybe you can just check whether we have any other information about the 2 other liabilities. The trade payables, the tax payable. And I think there is no information yet we are given about the payment of these 2 liabilities. They will appear here. So we have trade payables. Trade payables is basically trade payables is basically 59. And then we have tax payable. Tax payable, we have what? We have 3,000. We have 3,000. So now that question, that is part C, equally relate at that point. So how many entries do we have here? 1, 2, 3, 4, 5, 6. Even if, for example, you're given half, you can see you'll be having how many marks? You'll be having 6. You'll be having 3. But I don't think they can give half because How many items may be missing here? This one, bank, maybe goodwill. Those should be 2 items. Those should be 2 items. 2 items. Yes, I don't think they can mark it at half. Maybe it was marked at 1. So I've said for the bank, for this ordinary share capital, see what you're given in note number 8. In note number 8, in note number 8, in note number 8, and also note number 1. So in note number 1, you're given the ordinary share capital 100 million. And then you're told in note number 8 that there are some shares which were issued to pay the purchase consideration. And therefore, the shares which were not issued to pay the purchase consideration were issued for cash. By the end of the day, our company had issued all the shares. Our company had issued all the 10 million shares, each share having a par value of 10. That's basically why we are arriving at the share capital of this company as 100 what? As 100 million. As 100 what? Million. Sasa? Yes, as 100 million. As 100 what? A million. So basically, that's how we should approach that particular question. How we should approach that particular question here. And basically, by doing that, you should be able to get over 15 marks. Over 15 what? Marks. So using that particular approach, you should not take even more than 40 minutes to do that question. And then I'm saying that you should be able to get more than 15 marks. So therefore, if you happen to come across this question, don't bother yourself computing the purchase consideration. Just use that particular approach. Use that particular word approach there. Now, we have another question here for merger. A question which was examined in 2018. A question for merger. A question for merger. And this is a very, very common area. These are very, very common areas. So what you'll do, you'll also attempt this question on your own using that particular approach. May 2021, there is a similar question to this. May 2021, you do it using this particular approach. May 2021, question number 2. Do that question using the same approach. Actually, if you go to that question, I think you'll be able to see that the requirements are almost the same. We're required to prepare those accounts to cross off the books of account of SWARA, and then the statement of financial position. So this question does not require the preparation of what? Of the journal entries, basically to open the books of account of the new company. But let's go to that question for merger. There was a question there for merger. Yes, November 2018, question 2. November 2018, question 2. November 2018, question 2. November 2018, question number 2. November 2018, so you are there, please confirm. November 2018, question number 2. Yes, can we take a small breather of 5 minutes before we look on this one? Do we take a small breather? Yes, let's just take a small breather. We come back at 9:05. We continue. 9:05, we come back. We continue. Yes, so let's continue. I hope you are back. Are you back? So that we can continue. So please confirm whether you're back. Confirm whether you're back. Confirm whether you're back. Okay. So I want us to go to this question for November 2018, question number 2. This basically is a question for merger. And let's go through the question. We see what we are told. The question reads, B Limited and H Limited are private liability companies operating in service sector. They have been reporting successive trading losses for several years, principally due to severe competition, which has put downward pressure on the revenue. So the directors of the two entities, who are also the main shareholders, have unanimously agreed to wind up the company's respective business and amalgamate them into a new company to be named as S Limited with effect from 1st October 2018. So we are given the statement of financial position of the two companies as at 30th of September 2018. That is B Limited and H. What do we have there? We have the non-current assets, which comprises of the PPE. We have the intangible assets, which are copyright. We have the current asset and the total asset. We have equity, which comprises of ordinary share capital, 7.5% cumulative preference share premium, and then we have losses. Then we have non-current liabilities, which comprises of 10% debentures, and then we have the current liabilities. Current liabilities comprises of trade payables and the bank overdraft. We have additional information about all the way to note number 10. So then what are we required to do here? We are required to prepare the foreign ledger account in columnar format. I'll be able to explain what you mean by that. To cross off the books of account of B Limited and H, realization account, preference shareholders salary members account, the ordinary shareholders salary members account. Part B, we are required to make the journal entries in the books of account of S to record the transfer of assets and liabilities. We are told to ignore narrations. So then part C, we are required to prepare the opening statement of financial position of the new company. Now, this one is basically a question for merger, because basically what you are told is that we have these two companies. As per the information we have in paragraph 1, we have these two companies, B Limited and H Limited. These companies have been making losses for a number of years, and therefore we are told that it has been decided by the directors, who are also the shareholders, to wind up these two companies and their respective business to be taken over by a new company to be known as what? To be known as S. So therefore we have B Limited. These two companies are merging, B Limited and also H Limited. These two companies are merging. Remember, in case of a merger, basically what happened is that the identity of the old companies disappear, and then a new company will be formed, which is known as what? S. So therefore, these two companies, because they are being liquidated, we refer to them as the selling, or basically the old company, the selling or old company, selling or old companies, whereas this one will be the new, or basically what? The purchasing company will be the new, or the purchasing what? Company. So what we need to do basically is we cross off the books of account of these two companies, B and also H, and then from there we open the books of account of who? Of S. Now, when crossing the books of account of these two companies, B and H, we need to prepare the normal account, the realization, ordinary shareholders, the preference shareholders, and members account. But do we prepare those accounts for individual company? No. So what we do, we prepare a single realization account, but with the two columns. A column for B Limited, a column for what? For H Limited. The same case now to the other account, the preference and the ordinary shareholder salary members account. So therefore, we will go straight to part A of that question. And basically, we prepare the ledger accounts to cross off the books of account of these old companies. So part A, we are required to prepare the ledger account. The ledger account to do what? To cross off books of accounts, books of account of B Limited and also H Limited. B Limited and H what? Limited. B Limited and H Limited. So we will start by preparing the first account, the first ledger account, and that is the realization account. The realization account. Now, this realization account have said we are going to prepare realization account for the two companies. That is basically B and H. So meaning that On the debit side, this is basically the debit side, we will have the details column, and then realization account for B. And it's always advisable to check how the information is given. For example, you can see we're given the statement of financial position for B, followed that with that of H. So also arrange your account like that, B and H. So the details, B and also H limited like that. So then I think our figures are also in million of shillings. We will come here and we indicate that all our figures will be in thousand of shillings. Yes. So then from there, remember this is now what you require to prepare in Roman 1 of the question. In Roman 1. So in Roman 2, we are required to prepare the ordinary shareholders, salary, members account. Also, we prepare this for the two companies. That is basically for B and also who? And H. B and H. B and H. So we have the details column, B limited and H limited. So the details are B limited and H limited, like that. Yes, and then next we have Roman 3. Roman 3, we have the preference shareholders. The preference shareholders, salary members account, salary members account. The format is the same. Details, and then we have B limited, we have H limited. On the credit side, the same columns, details, B limited and also H limited. The values are in thousand of shillings. The values are in thousand of shillings. Are in thousand of shillings. Sasa, like that. And let's assume, for example, in this question, we also require to prepare the purchasing company account. So basically, not much entries we can be able to make in that account, because majorly what we record there is the purchase consideration. But let's also prepare that account. We see what we can record with in that account without necessarily or without having computed the purchase consideration. So what do we record in this account, which is called the purchasing company account? The purchasing company in our case is S limited company account. And remember here, purchasing company is 1. So therefore, we are not preparing for B, we are not preparing for H. The purchasing company is what? Is S. Yes. Now, having that, I think what we need to do is basically remove and prepare this particular account. Let's proceed and prepare these accounts. And remember, we prepare this account basically to cross off the books of account of the two old companies. So what we do, just like what you have done in the other question, we go back to the balance sheet of these two companies. The balance sheet of these two companies, B and H, we start with crossing off the asset account. So we have a number of assets there. We just need to know which assets were taken over by the new company, which assets were being written off. So that information I can see it in note number 8. So we are told that tangible assets were taken over by S at the following fair values. The assets which were taken over include PP, current asset. Now, you can see, I think in the balance sheet, we have how many assets? PP. We have intangible asset, which is copyright, and then we have current asset. We must be given some information about intangible asset. What is happening to the intangible asset? Because intangible asset is not one of the assets which was taken over. Now, that information, we have it in note 7. In note 7, you're told the copyright of B, which is basically the intangible asset, expired upon amalgamation of the old companies and therefore was to be written off. So therefore, the corporate, which is the intangible asset, was to be written off. So therefore, starting from where we have the asset, the PPE of the two companies were transferred to the new company. So we need to debit them in this account at their book values. The book values or the carrying amounts, these are the values we have in the balance sheet. So the PP of B, 16,500, the PP of H, 12,000. So then from there we have the intangible asset. Intangible asset, this one was written off. So being an asset which was written off, we basically debited here. Intangible asset, and this is only for B, 84. This company didn't have intangible what? Asset. Then from there we have current asset. And current asset, we are given the total. As per note number 8, current assets were taken over by the new company. So being assets taken over, we debit that here, current assets, which is how much? 52,500. And basically how much? 30,000. That's basically what we have there. Then we go to equity section. In the equity section, we start with the ordinary share capital. So the ordinary share capital basically will be credited in this account here. Ordinary share capital. Ordinary share capital. Ordinary share capital for the first company is basically 30,000. For the other company is what? Is 16,000. Below that, we have preference share capital. Preference share capital is crossed off to this account. So we need to credit this account. 7.5% preference share capital. For B, this one is 10,000. This one is what? 24,000. So then below that, what do we have? Share premium. All the reserves should be crossed off to this account. Basically, we credit that to this account. The share premium. The share premium for B is basically 16. The share premium for H is what? Is 1,400. And then from there, we have the losses. Losses should be debited in this account. So we refer to them as accumulated losses. Accumulated losses, we have 23,400. And then we have 34,300. Sasa? Yes, I hope you're together up to that point. Then from there, we go to the liabilities. Liabilities, we have non-current liabilities and current liabilities. So what are we told about these both? What are we told about the liabilities? So I think in note number 6, we are told the current liabilities of the old company were transferred to the new company. The current liabilities were transferred to the new company. There is another information which is given with respect to the both, and that information is in note number 4. The information for both is given in note number 4. We are told the bondholders in both companies were settled by issue of by the new company issuing ordinary shares of shillings 10 each to satisfy the nominal value of the boat. So basically the boat, which is non-current liabilities, this one was not transferred to the new company, but basically the bondholders were paid. And we said, if you can remember the question we did yesterday, we said that usually the bondholders or the debenture holders are paid their full amount. They do not suffer any loss. That's why we say there is no need of preparing an account, which is called, for example, in this case, the bondholders, ordinary shareholders members account. So that is the bondholders sundry members account. There is no need of preparing that account because generally this account and this one, we prepare these two accounts to determine how much loss was suffered by the ordinary shareholders and the preference shareholders. The bondholders were paying the full amount, so they didn't suffer any loss. Sasa? Yes. So therefore, we will not prepare that account. What we will account for there are the liabilities, the current liabilities. The current liabilities which were transferred to the new company, we do what? We credit them in this account. We start with the trade payables. The trade payables. The trade payables, we have 37,200 for B. For H is 18,400. Then below that, we have bank overdraft. We have the bank OD, which is 2,000. And basically what? 15. And what? 15. You can see we have crossed off all those particular accounts. Then we have said we must always remember to account for two additional items which will not be part of the balance sheet. One of it is the preference dividend in arrears, and number 2, the liquidation cost which was paid by the new company. I think we can first of all, account for the liquidation cost. This one is in note number 9. I can see it in note number 9. We are told the liquidation expenses of B and H amounted to 8 million and 5 million respectively, and were paid by S Limited, and S Limited treated this as preliminary expenses. Yes. So the liquidation cost, which can also be known as the dissolution cost, paid by the new company, that one we have said should be debited in this account, and that is 8 million and basically 5 million. And then we have said that the double entry for this is to credit this account, to credit the purchasing company account. So we have the liquidation cost. So the liquidation cost, you can show which the amount which was paid for B and the amount which was paid for H. Remember, I've said that this account will not be prepared for in columnar format. We have one purchasing company, that is S. So this one is 8 million, and this one is what? Is 5 million. So then from there, finally, we account for what? The preference dividend in what? In arrears. In all questions for external reconstruction, we come across this. So where do we have that information? We have it somewhere either within note 1, 2, 3, 4, or 5, there, somewhere there. So that information is given in note number 2. In note number 2, here, so the preference dividend in B were 3 years in arrears, while in H Limited, while H Limited preference dividend had not been paid for 2 years, including the current year. In other terms, the preference dividend for H were 2 years in arrears. For B, they were 3 years in arrears. How do we compute, or where do we get the information to compute the preference dividend in arrears? You don't need to go back to the balance sheet, just come to this account here. You'll be able to see that the preference shares issued by the two companies were 7.5. So meaning that the preference dividends which were in arrears for B, this company here will be 7.5% of the preference share capital 10,000, and you're told those dividends were in arrears for 3 years. The preference dividend in arrears for H will be 7.5% times the amount of preference share capital 24,000 times 2 years. The dividends for H were 2 years in arrears. Yes, so I'm told this one will be 2250. I hope that one is for B. I hope that one is for B. I hope that one is for B. Yes, that one is for B. What about the other company? That is H. H. Is it 36? That is 600. That is 6. That is 600, eh? That is 600. Yes, that is 600. So we need to account for those dividends here. So for B, 2250. For H, that is 6. So we debit this account and then we credit this, the preference dividend in arrears. So we have 2250, and basically that is what? That is 6. So that part A, you leave it now at that point. You'll have scored all the marks. You'll have scored all the marks. You'll have scored all the marks because you can see the marks are located here. The marks are located here. Someone is saying my video is not clear. Maybe someone to confirm. Is my video clear? Please confirm. Yes, I'm told my video is clear, Fred. Check on what is happening on your side. Yes, so you can see the marks are located here or 4. So these are the items which will earn you the marks. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Even if you are to be given a half, which is the minimum, you have the 4 marks there. So the marks given here are 4. 1, 2, 3, 4, 5, 6, 7. Remember, I said that in most of the cases, this account and this one, the entries are given 1 mark. 1 what? 1 mark. So, but even if, for example, you're given half, 1, 2, 3, 4, 5, 6, 7. So 7 times half is basically 3.5. This should be rounded off to 4. So this one, okay, yes, this one here, the marks are given are basically 4. Usually this one I've said this one for every correct entry here, the marks to be allocated will be 1 for every correct entry, because here we don't have so many entries. Yes. So you can see by doing that, you already have so many marks with you. And then from there, we need to move and basically answer part B. Part B, what are we required to do? Part B, we are required to make what? The journal entries. To do what? To open the books. To open the books of S Limited. To open the books of account of S Limited. And just like what you have done in the other question, we will basically account for 3 items only. The asset which were taken over, at fair value, the liabilities which were taken over, and also the purchase consideration which was paid. And like in our question here, we are told no narration which are required, but let's just put some small explanation regarding what we are accounting for your revision purpose. We first of all account for the assets which were taken over. The assets which were taken over here at the fair value. So the assets which were taken over at the fair value, we have said that those assets should be debited in the respective asset account and then credited in what? Credited in the business purchase account. So the assets which were taken over, we have them in note number. 8. The assets which were taken over, the first asset is property, plant, and equipment. So remember this company, that is S Limited, took over asset from 2 companies. Took over asset of B, took over asset of H. But it's obvious that this company will open a single PP account. So the amount to be debited there should be the total. Should be the total fair value of the assets which were taken over from the 2 companies. So the amount to be debited in this account will be the total fair value we have in note number 8. That is 12.5. And basically what? And 95. And 95, the total. Will that give us 22,000? Yes. So then from there we have the current assets. The current assets, we have 58 plus 38.6. That will give us a total of what? That will give us a total of 96. 600 there. 600. Is that what you're getting? 600. Yes, give me the total. So the total current assets. Yes, so 600. Then there is something you have said we always need to check. The preliminary, the liquidation costs, which were paid by the new company on behalf of the old company, were they capitalized? Were they treated as preliminary expenses in the books of account of the new company? Yes. So that information, we have it in note number 9, that the liquidation expenses of B and H were 8 million and 5 million and were paid by S, and they were treated as preliminary expenses. They were capitalized. So we have 5 million plus 8 million, and basically that will give us 13 million. These are the assets which were taken over, and then we credit the total in the account called the business purchase account. So what will be the total here? So this will be 131, 600. 131, 600. So total asset taken over. Then from there we can account for the liabilities. Which were taken over. The liabilities which were taken over. We have them from in the realization account. These 2 liabilities, the payables, and the bank overdraft. So we have said we debit the total amount in the account called the business purchase, basically with the total, and then we credit the trade payables. The trade payables will be credited with the total amount here. That is basically 37,200 plus 18,400. And basically that will give us a total of 55,600. 55,600. And then we also credit the bank overdraft. The bank overdraft, we have 2,000 plus 15. And that will give us what? That will give us 35. So the total amount, which now will be 59,100, that one will be debited in the business purchase. Will be debited in the business purchase. Are those additions correct? Are the additions correct? Are those additions correct? Yes, they are. So then from there, we proceeded. Basically, we account for what? We account for the purchase consideration which was paid. Purchase consideration which was paid. Number 3, purchase consideration which was paid. So the purchase consideration which was paid, we have said that this one will be debited in the account which is called the selling company account, and then credited in what? Credited in the bank. We debit selling company. So selling company, we have 2 companies, that is B and basically what? H Limited. So the purchase consideration which was paid on behalf of B is 8. Record that separately here, and basically 5 million. And then the total amount, that one should be credited in the bank account. That is 13 what? 13 million. That is the purchase consideration which was paid. Oh, sorry. sorry. I think, no, that one should be liquidation, not the purchase. Sorry for that. The liquidation cost. I think Morimo is moving too fast. Thank you, Cyrus. Yes, that one should be the liquidation. That one should be what? The liquidation cost, not the purchase consideration. Sasa? Yes. So, do we have anything else maybe you can account for here? I think none. So equally, you can leave that part B at that point. At that point, how many entries? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So the marks are located at 4. Even if you're given a half per every correct entry, you already have all the marks with you. Sasa? Yes, even if you're to be given half marks per every correct entry, you'll have scored all the marks. You'll have scored all the marks. So these questions are very, very simple. If you happen to come across this question, you should even start smiling. Even before start doing that question, you should start smiling, because these are questions you should be able to get over 18 marks. Over 18 marks. So these are questions which is very, very good, simple. So we finalized by basically preparing the statement of financial position. Statement of financial position as at 1st of October 2018. As at 1st of October 2018. So equally, so many free marks are here. We start by recording the non-current assets. Non-current assets. Non-current assets. And in our case here, we have a number of non-current assets, starting with the assets which were taken over as per note number 8. And I think we have already made a journal entry for that. We'll start by recording the PP. And I think the PP have gotten the total, which is 22,000. So that will not change. So then from there, we have current asset. Current asset, we record that down here. But before we record the current asset, we record what? The preliminary expenses, the liquidation expenses which were paid by the new company, but basically capitalized. The total is 13. is 13. Then from there, we have the current assets, the current assets, the current asset was a total amount of how much? Current asset was 100 and what? 1 what? Current assets, 96, 600, eh? Yes. So then from there, we proceed and record the other items. Like I think for this particular question here, we can't be able to determine the share capital because for us to compute the share capital, we have to go back and compute the purchase consideration. And like the other question which you have done, whereby we are told the company had issued all the shares, so which were not issued to pay the purchase consideration, there is no information which are given in relation to that in this question. So it automatically means that in this question here, we can't basically be able to determine the share capital of this company. We can't be able to determine the ordinary share capital. I think maybe what we can record here are only the current liabilities which were taken over. So equally, we don't have any non-current liability. I think we only have current. And it is obvious that this particular bank overdraft will have to be paid because our company must raise some cash through the issue of the share. So I think what we'll have here is only one, that is the trade payables, and which should be the total. That is 7,200 plus 18,400 plus 18,400. And this will give us a total of 55,600. 55,600, is that what you're getting? Yes, 55,600. 55,600. 55,600. Is that what you're getting? 55,600. 55,600. Yes. And basically, these now, I think, are the free entries which you get here. 1, 2, 3. 1, 2, 3, 4. Even if, for example, you're given half, you have to be given half, assuming you have to be given half, you can see still, you'll also be able to get 2 marks out of 4. Out of 4 marks, you'll be able to get, should be able to get 2 marks. Now, basically what I've said is that this question, if you happen to come across this particular question, make sure you do that question. You can start even with this question and make sure you get over 15 marks. You make sure you get over 15 what? Marks. Using that particular approach which I've shown you, you should be able to get more than 15 what? Marks. The other thing is that is a question to be done within even 30 minutes. 30 minutes you are done with that question, you get more than 15 marks, and basically you move to the other what? To the other questions there. Yes, Cyrus, in this question, we can't be able to conclude that the share capital of this company would be 120. Because if you can be able to recall the other question, which I've done, there were some shares which were issued to pay the purchase consideration, even in this question, but automatically some of the shares were not issued. You see the reason why the other question we have taken the share capital is equal to the registered share capital is because there was an information that those shares which were not issued to pay the purchase consideration, all of them were issued for cash. By the end of the day, that company had issued all the shares. In this question, do we have such information? In this question, we don't have such information that our company here issued all the remaining shares for cash. That is the difference between the two questions. Sasa, that is the difference between the two questions. Now, that is it. That's basically how we account for this. But you can see this question is a question for merger. But is there any difference between how we account for merger and external reconstruction? You can see there is no much difference. No much difference at all. No much difference. Now, there was another question, although that one, there is a concept which was incorporated in that question. I don't know whether I can, yes, I can guide you. I think we have some few minutes. Let's go to this question here. The question for yes, the question for December of 2022. For 2022, yes, this one is quite simple. If you happen to come across this question, I'm saying you should always start smiling because these are free marks. Very free marks, and which you'll be able to earn within a very short period of time. Within a very short period of time, because as I mentioned yesterday, what makes this question to take a lot of time is the computation of purchase consideration. If you decide to compute the purchase consideration, you'll not be able to finish this particular question. And that purchase consideration will not even earn you a lot of marks, but it consumes a lot of your time. It consumes a lot of your time trying to compute that purchase what? Consideration. Can we go to this other question for December? December 2022. December 2022, and that is question 5. Question 5. Yes, question number 5. This one is a little bit different, but what happens is that in that question, there is a concept which the examiner has incorporated here on compound financial instrument. On compound financial instrument, you'll be able to see that some of these particular questions, in some instances, the examiner may try to test a different standard. Like this question, it was testing a concept on compound financial instrument, IFRS 9. So let's go through this question. We see what you're told. And you're told 𝐻𝐍 Limited, a private limited company, has been in financial difficulties and has reported trading losses for a number of years. The directors of the company invited the shareholders and the creditors for a special general meeting where it was resolved that the operation of 𝐻𝐍 Limited be transferred to a newly formed company, which is to be known as 𝐍𝐋𝐈𝐍 Limited, with effect from 1st of August 2022. So this company, which is called 𝐻𝐍, this company will be liquidated. So meaning that this is the old, in other terms, this is the selling company. And its business operation will be taken over by a new company, which is called what? Which is called 𝐍𝐋𝐈𝐍 Limited. So basically, this is the new or the purchasing company. Sasa, yes, that is the information which we have. And then from there, we have the statement of financial position of this company, which is called what? 𝐻𝐍. And then from there, we have additional information, number 1, all the way to note number 10. So then what are we required to do here? We are required to prepare the foreign ledger account to close off the books of account of 𝐻𝐍. So no much problem with that. No much problem with that, because you just need to do what you have done in the other 2 questions. Now, what I want us to do is there is part B of that question. I think I will not do the entire part of it. Maybe I'll show you part of it, part B. So we are required to make the journal entries in the books of account of 𝐍𝐋𝐈𝐍 Limited to record the initial recognition of the 8% convertible bonds and the right issue on 1st of August 2022. Now, in this case here, the examiner, I think, tested 2 concepts here. Something to do with 8% convertible bonds. And remember, we say that if, for example, a company issue convertible debt instrument, what you need to remember very fast is that this is a compound financial instrument. And I hope you can be able to remember, we say that as per IFRS, as per IS 32, anytime the company has issued a compound financial instrument, e.g. convertible bonds, we say the company should split the 2 components, the liability component and the equity component. Now, that is what the examiner was testing here. You can see that is a totally different concept from the question itself, because that is a concept from a different study. And I think there was some information about what? The right issue. Where do we have the information about 8% convertible bonds? Where do we have information about the right issue? I think we will start with the 8% convertible bonds. So where do we have this information about these bonds? This information is given somewhere in note number 5. given in note number 5. Can we go to note number 5? In note number 5, we are told the bondholders in Tahidi Limited. Tahidi Limited, remember, is the old company. Can we go back to the balance sheet of Tahidi? We know that the board is part of the non-current liabilities. So this company here had issued 12% bonds, having a value of 12.5 million. So those are the bonds which were issued by the Tahidi. So let's go back to note 5. We are told that the bondholders in Tahidi Limited agreed to be transferred to the new company on the condition that the bonds would be converted into ordinary shares after 3 years. And then you're told the coupon interest rate for the convertible bonds were 8% per annum. And then you're told similar bonds with no conversion rights attracted an interest at the rate of 10%. And then you're told the accrued interest on the bonds were to be paid immediately. I think we can ignore that last statement. But basically what you're told is that these particular bonds, which were issued by this company, that is Tahidi, these 12% bonds, they were basically transferred to the new company. They were transferred to the new company. In other terms, they were taken over by the new company, but they were transferred on which condition? They were transferred to the new company on the condition that the bonds will be converted into ordinary shares after 3 years. It basically means that once these particular bonds were transferred to the new company, they became 12% convertible bonds. That's why we are told they were transferred on the condition they will be transferred into ordinary shares after 3 years. So once they were transferred to the new company, they became 12% convertible bonds. 12% convertible. Okay, I think the interest rate also changed, because if you check on the other sentence, we are told the coupon interest rate for the convertible bonds was to be 8%. So this one became 8% convertible bonds. Now, basically, even before you go to the other information, what you needed to remember here is that this is what is a compound financial instrument. These are concepts we covered in the topic of financial instrument. And actually, we say that anytime the company has issued a compound financial instrument, according to IAS 32, the company on initial recognition should split the liability component and the equity component. That's what you needed to do as per that point. So what we need to do is we split the two components. So remember, you say to split the two components, we follow 2 steps. Step 1 is basically to compute the liability component. We compute the liability component. And actually, we're going to compute the liability component on the dates they were transferred to the new company. So I hope you can be able to recall the transfer. Maybe we can go back to note number C in the requirement. What you have in part C, we are required to prepare the opening statement of financial position of the new company on 1st August. So it automatically means that all the assets and liabilities of the old company were transferred to the new company on this date, 1st of August 2022. 1st of August 2022. So what basically we need to do here is we compute the liability component. I hope you can be able to recall how we were computing the liability component for the compound financial instrument. We say that this one will be equal to the present value of the annual interest minus, that is plus, the present value of the principal amount. I hope you can be able to remember that formula. That is something we covered in the topic of financial instrument. So what we just need to do is to compute the annual interest. The interest to be paid annually. And we said the interest per annum, this one is equal to the, this one is equal to what? This one is equal to the coupon interest rate. Coupon interest rate. We multiply that with what? We multiply that with the nominal, the par, or basically the face value. So if you check the information which you're given in that note number 5, you'll be able to see that we have 2 interest rates. We have this one, which is the coupon interest rate, and also we have another interest rate, which is 10%. 10% is the effective interest rate, which you use for discounting. So therefore, the interest to be paid by our company annually will be equal to 8% of the nominal or the par value. Remember, when these particular bonds were transferred to the new company, they were transferred at their fair value here. At their value, that is 12.5. So therefore, the interest to be paid annually will be that one, which will be 8% of 12.5. So let's work out this 8% of 12.5. And basically that will give us what? That will give us 1,000 per annum. And this interest, who can tell us, it will be paid for the next how many years? Because there is some information we are given in note number 5. What is the life of these convertible bonds? Yes, their life is 3 years. Their life is 3 years because we are told they will be converted at the end of the 3rd year. This will be paid for the next 3 years. So that is basically the annual interest. What about the principal amount? In this case, we say the principal amount. This one is always equal to the par value, unless otherwise stated. Unless otherwise what? Unless otherwise stated. And there is no information which are given here about the amount to be paid on redemption. So the amount to be paid on redemption will be this one, will be the par value or the nominal value, which is this one, which is 12.5. That is the amount to be paid at the end of the 3rd year. So what we just need to do to discount those items, we first of all start by discounting the annual interest, this one, 1,000. So that one will be equal to 1,000. We multiply that with the present value interest factor of annuity, and we discount this using the effective interest rate, which is 10%. 10% for 3 years. And then we add this, we discount this, which is basically 12,500. We multiply that with the present value interest factor at the rate of 10% for 3 years. Remember, these are an annuity, these are lump sum. Sasa? Yes. So the formula for discounting the two will be different. So we have 1,000. So the formula, this one is 1 minus 1 plus R, which is basically 1.1 raised to power negative 3 divided by 0.1. So what about this one? 12.5. This is an lump sum. This will be 1.1 raised to power negative 3. That is basically how we discount that. So what is the present value interest factor of annuity here? Is 1.1, which is raised to power negative 3. We 1 minus answer divided by 0.1. Yes, times 1,000. Times 1,000. So in this case, I'm getting 24. 24 to the nearest whole number, 2487. To the nearest whole number, yes. So what about this one? 1.1 raised to power negative 3 times 12,500. So this one is 9391. So therefore, the liability component, the value of the liability component will be equal to the total, which is 2487 plus 9391. So this one will give us 11,878. What is that? That is the liability component. Having computed the liability component, we said step 2 is to compute the equity what? To compute the equity component on the same date, 1st August of 2022. And actually we said to compute this, we take the sales what? The sales profits, or basically the amount which was received. In other terms, the sales proceeds, or basically the amount here, will be equal to the value now, which was basically paid, because now the holder of this particular bonds were paid this amount. Yes, were paid this amount, 12.5. Yes, so we take that minus the liability component. The liability component on the same date which is what you have computed there, 18,787. So what do we get here as the equity component? The value of the equity component. The difference. So which is what? Which is 622. Now, what the examiner is requiring is you make the accounting entries, or you show the accounting entries or the journal entries on this date, that is part of August 2022. So how will our company account for this? How will our company account for this? Remember this basically a liability which was taken over. So being a liability which was taken over, this one should be debited in which account? This one will basically be debited in the account which is called the business purchase account. Sasa, because it's a liability. So with the total amount 12,500, and then we credit to account. We are going to credit the first account which is called the liability component of the convertible, that is 8% convertible bonds with this particular amount. This is the liability component. And then we credit the other account, which is called what? The equity component of 8% convertible bonds with this particular amount there. So this basically what was examined here, but you can see what the examiner here was testing is on the candidate's knowledge on IFRS 9 and also IS 32. So a concept which is totally different from the concept of what? The concept of reconstruction. I think for the right issue, we will not do it because of time. But essentially, what you need to do, can you do the other part? You do part A, and also you do what? You do part C. So I think that was the only tricky part, but basically that is the concept which was being what? Explained. Sasa? Yes. So that should bring us now to the end of that area of external reconstruction. And maybe we will see if we can get some time, because this is an area which I expect it may be tested. Maybe we are going to revisit it if we will get some more time. But make sure you attempt the 2 questions. This one you finish on it, and the other question for, I think, for December 2021. And you try to use that approach which I've shown you. Try to use that particular approach, and you see whether you can be able to do what? Yes, now when preparing the statement of financial position of the new company, this one will appear under equity. This one will appear under equity in the statement of financial position. This one will appear under the non-current liabilities in the statement of financial position. Sasa? Yes. So that's how they will affect the statement of. Remember how if you go back to what we did in relation to this, you'll be able to see how you are recording this compound financial instrument. Sasa? Yes. So I want us to stop at that point for today. We continue from there on Saturday as we revise on something else. So can we start by revising still cash flows? Can we go back to cash flows before you forget that concept? Cash flows? Yes. So can you check on cash flows? Check on group cash flows. I think we will equally try to do like 3 questions using that shortcut. Using that shortcut, which basically we are using here. You revise on that. That is what you're going to revise on Saturday. Group statement of cash flows. Sasa? Yes. So we stop at that point for now. Have a good night. See you on Saturday.
check whether the class is to ensure we are recording. So now we have missed something, but no problem. So we are saying, so maybe just a recap. So we have said time value of money. It is that the fact that over time the value of money changes. The value of money does not remain the same. And I'm saying, assuming here now that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here we have shillings 1 million. So we're saying the value of 1 million shillings today. This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. Which one is better? And we said, holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million because this, it may be, maybe if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount will be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Oh, okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction and we have this direction. So this is to say, You can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But you want to know what is the worth? What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting is determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you're supposed to compare the two, you cannot compare when they are not in the same form. You're supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money. Introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, yeah, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why there they are saying compounding techniques. compounding techniques. So we start with the compounding techniques number 1. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So just write concepts of compounding, or compounding techniques, and we start with the first one: future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal. 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you're paying or receiving 400,000. That is an annuity. Or each year you're paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year 1, you'll receive 300,000. In year 2, you're getting 550 or paying or 550. Year 3, 600. Year 4, 700. Maybe let's say year 5, 300,000. You cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000s that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year 1 and year 2, or period 1 and period 2, we have an annuity of 300,000 because they follow each other. Yeah? But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year 1 and year 3, we have 300,000. These are not annuities, they are lump sums because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear, a lump sum and an annuity. This is a concept that we are going to use a lot in financial management. And that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus r power n. Principal times 1 plus r power n. And this is what you call present value. Present value. This principal figure here is what we call present value. Let's see what we have in the handout there. Check what we have there. Where are we? Where are we? Future value of a future value of a lump sum should be there. If you look at the handout, you'll see using tables to find future. No. Equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus r power n. This factor here, this factor 1 plus r power n is called what? Future value is called future value interest factor. This one is called future value interest factor. Future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus r into bracket power n. So here we can say where FV is future value, R is the discounting, or not discounting rate, but rate of return. of return. It's important for you to write this formula. Just write this, just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Yeah. Do we have an example there? So the example, yeah, there should be an example somewhere. Yeah, there is an example there. Look at that example. They're saying, assume that you've just invested Kenya shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually. Determine the future value of the investment after 3 years. So, okay. Let's look at that. We are doing that illustration, that example. We're saying, assume that you have invested shillings 100,000. That is the present value. That is the principal. The principal amount, which is present value amount, is Kenya shillings 100,000. 100,000. Then the investment is expected to earn interest at the rate of R is 20% per annum. This per annum is very important. Okay, it is not given. They have not said per annum, but we say when you get a rate of return where the period, whether the per annum, per month, semi-annually is not stated, the standard measure is per annum. So unless it is specified like semi-annually or what, you should take it as per annum rate. So per annum is 20%, compounded annually. Determine the future value of the investment after 3 years. N, we should have said N here. N is equals to number of periods. Number of periods. Kindly have that. Number of periods. Number of periods. Make sure you write that. So here, our period is 3 years. We are investing for 3 years. So future value we are saying is equals to present value 1 plus R power N. So future value is equals to 100,000 times 1 plus 0.2 power 3. Power 3. So get the value of the investment after 3 years. Value of the investment after 3 years is how much are you getting? There are people, no, but you must be knowing how to put this power 3 in calculators. Anyone who doesn't know, you will be assisted. Now, for example, we have two answers here. We have 172,800 and we have 106,120. Alice, I'm doubting your answer. At a rate of 20%, even in the first year, we are going to earn 20,000. Because first year one, we will say 20% times this. Times 100,000, that is 20. That means it's more than 106,000. So 178, probably 172,800. 172,800. Alice, repeat your calculation. Okay, yeah, 172,800. That is what you're supposed to do. Another method of getting this. Another method of getting this is OR. So here you say OR, a very long method. You'll say period here, period 1, 2, and 3. Amount amount with, let's say, 100,000. No, will that give us? No. No, that is the only way. Okay. The other method is where we say, but this one is very long. Where you say here it's 1 plus 0.2. The figure that you'll get here, you bring it here. Then you continue. But that will not apply in this case because we are only investing 1. So you can continue. You grow by that rate. So just stick to this. Just stick to this. Any question before you continue? We want to proceed. Okay, number 2, future value of an annuity. Future value of an annuity. Future value of an annuity. Future value of an annuity, and you have seen how we get the future. I've explained what's an annuity. Future value of annuity. Future value of annuity. Now, a future value of an annuity, just like we've said, you get the annuity. It's an annuity when the amount occurs repetitively, but regularly. So future value of an annuity is computed as follows. Without wasting a lot of time, future value of annuity is equals to the annuity. You get the annuity amount times annuity amount times. So we have the future value annuity factor. The future value annuity factor, you say 1 plus r power n minus 1 over r. That's how we get the future value of an annuity. 1 plus r, and write these formulas because the way they are in the handout. Okay, they are very much simplified in the handout. Just write what I'm writing on the board. Yeah, it's there, but write. Future value of an annuity is equals to annuity times 1 plus r into brackets power n minus 1 over r. This factor here, the factor 1 plus r power n minus 1 over r is called future value interest factor of an annuity. Future value interest factor of an annuity. What have they said there? Future value interest factor of an annuity. Future value interest factor of an annuity. This one. Now, we have tables. We have tables where these factors can be read from. Like, you remember what table do we have? We have math table. Do you people know what's a math table? Or maybe what we call what? Normal curve, normal distribution curve. We have tables. We have tables where you can read these factors. When we go to discounting, I'm going to share the tables so that we can see. But for future values, the tables for compounding, it's not widely used in financial management. So just get these formulas right. Yeah. So any question here? There is nothing to explain. We know R is the rate of return, or the interest rate. N, it's the number of periods. So there is nothing to explain. Let's go to what? Let's have an illustration. Do we have an illustration there? From the above example, there is a statement that says no. No, we have an example. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest of 12%? Are you there? Have you seen that example? And finding future value of an annuity. Oh, that's due. Sorry. What is the value of 100,000 investment annually at the beginning? That's an annuity due. We are coming to that. I want us to have an illustration on the illustration on future value of an annuity. Okay, let's say from the above example, there is a part that is missing here. There is a part that is missing, but all in all, let's just write an example there. Just write something. Just write an example, an illustration. Say an investor intends to invest. An investor intends to invest shilling 60,000 at the end of each year for 4 years. An investor intends to invest shilling 60,000 at the end of each year for 4 years. At the end of each year for 4 years. Full stop and say, the investment will earn interest. The investment will earn interest at a rate of 20%. The investment will earn interest at a rate of 20%, compounded annually. The investment will earn interest at a rate of 20%, compounded annually. Compounded annually. Full stop. Determine the future value. Determine the future value of the investment. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. After 4 years. Now, future value of the investment. Now we start. This is how you should be approaching these questions. You first analyze the question. For example, here we are saying amount to invest is 60,000 at the end of each year. So annuity. We say annuity. Shillings 60,000. Annuity shillings 60,000 at the end of each year for 4 years. Period is 4 years. 4 years. Then the investment will earn interest at a rate of 20%. So 20% per annum. So we want the value of the investment after 4 years. So future value of annuity is equals to the annuity times 1 plus R power n minus 1 over R. So here you say 60,000 times 1 plus 0.2 power 4 power 4 minus 1 over 0.2. So get the value of the investment after 4 years. Then I show you another way of doing it. Get the answer, get the answer. Get the answer. Three 322,080. Another person. 322,080. Another person. Alice, okay, that's fine. Now, there is another way of doing this question. So this is now, you say period, 1, 2, 3, 4. Annuity or amount. Remember, this person is investing 60,000 at the end. Yeah, at the end of each period. 60. 60. 60. 60. At the end of each period, this person is investing 60. So here you say 1 plus R power n. If we want to treat each amount as a lump sum, then here we will have future value. Future value. So here we will have 1 plus R. 1 plus R. This is 0.2. 0.2. 1 plus 0.2. 1 plus 0.2. 1 plus 0.2. 0.2. 1 plus 0.2. So before that, we know we've not put n. That is what I want to illustrate here. That is what I want to illustrate here. So we are 0. We always start at 0. 0 means now 1, 2, 3, 4. We're talking about 4 years, which is 1, 2, 3, 4. So here we have at the end. We are investing at the end. So at the end of the first year, 0, 60, 60, 60, 60. I want us to put n. So this 60 that you've invested at the end of year 1, how many times will it earn interest? The 60 that you invested at the end of year 1, how many times will it have earned interest at the end of year 4? It is here. 1, 2, 3. We have invested 60 here, so it will earn a return here, a return here, and a return here. So you say power 3. That is power 3. Then the other 60 at the end of year 2 here, it will earn interest here and here. So you say power 2. The 60 that you invest at the end of year 3, it will earn interest once. So you say power 1. And the last one, the 60 that you are investing at the end of year 4, it will have earned no return. So you say power 0. So multiply and get the total. If you multiply and get the total, we should be getting the same answer as this. We should be getting the same answer as this. So the reason why I just want you to get the concept, the concept here of power what, power what, power what. So 103,680 must be the first one. 103,680. 103,680. 86,400. 72,000 and 60,000. So get the total. Get the total. $322,088. Yeah. So almost the same as what we have here, just because of rounding off, that's where there are differences. So is that okay? Let's proceed. Let's do the next one, then we go for a break. The other one is future value of an annuity due. Future value of an annuity due. Let's wrap this. Future value of an annuity due. Now, what we have talked about here, it is an annuity that occurs at the end of the period. So here we had 60. If an annuity occurs at the end of the period, like in this case, that is what we've done in part B. But now we have what we call, okay, fine, Alice, 080, okay, fine. So future value of an annuity, this is when the amount is invested or paid at the beginning of the year, at the beginning of the year. For example, if our 60 here, 0, 1, 2, 3, 4. If the investment is done at the beginning of the year, for example, here 60, 60, 60, 60, 60, we call it 1, 2, 3, 4. This is not there. We call it an annuity due. So an annuity due is an amount that is invested or paid at the beginning of the period. And this will change because now, like here we had said this is power 3 because we counted here 1, 2, and 3. But if it's an annuity due, we will now have 1, 2, 3, 4 because we are going up to the end of year 4. Because we are going up to the end of year 4. So the amount that we invested at the beginning of year 1 here will earn interest 4 times. 1, 2, 3, 4. The amount that we invested at the end of year 1 will earn interest 1, 2, 3. This will earn 1, 2, and this will earn 1. So the entire thing will change there. But now, how about when we are using the formula? When we are using the formula, this is how we get the future value of an annuity due. So here we say future value of annuity due is equals to annuity times 1 plus r power n minus 1 over r. Then we add another factor here, 1 plus r. 1 plus r. 1 plus r. 1 plus r power n minus 1 over r times 1 plus r. So this is now what caters for the element of investing at the beginning of the period. So you can write that. And then we have an illustration. So back to the handout, there is an illustration. Finding value of an annuity due. We have an illustration for that. If you can check in the handout, they are saying, assuming the above example, the investment is made at the beginning of the year rather than at the end. So example, what is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest rate of 12%? So let's do that. So we're saying, what is the value of shillings 100,000? So annuity, the annuity is 100,000. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years? The period is 5 years. Interest is 12% per annum, and it's at the beginning. So future value of annuity due is equals to the annuity, and you need to be writing these formulas every now and then. Every time you're doing a question, kindly write the formula. Even if you know the formula, just write it. So annuity times 1 plus r power n minus 1 over r times 1 plus r. So annuity is 100,000 times 1 plus 0.12 power 5 minus 1 over 0.12, then times 1 plus 0.12. So get the value. Then you are going to use this method to see. So how much are you getting? 711,518.9. 711,518.9. Now, using this method, we will have this. We will have here 0 here. 1, 2, 3, 4, 5. And remember, the reason why we are starting at 0, you must count 12. Oh, someone else is getting 424, eh? 711, 424. Okay. Another person? A third person? Okay, let's continue as we wait. So, 513, 518, around that range. Now, so I'm saying we start at 0 because we must count 518. Okay, fine. Let's go with 518. We must count 12 months before we call it a year. So we are saying we are investing 100,000 at the beginning of each year. 100,000, 100,000, 100,000, 100,000. Remember, the end of year 1 is the beginning of year 2. So this 100,000 here we are investing at the beginning of year 2, which is the end of year 1. So we are saying this first 100,000 that was invested at the beginning of year 1, how many times will it earn interest in a period of 5 years? 1, 2, 3, 4, 5. So you say power 5. The other one is power 4, power 3, power 2, and power 1. The last one that we are investing at the beginning of year 5, it will also earn interest during year 5. So at the end of year 5, it will have earned once. That is why we are saying power 1. If you do the future value here, you're supposed to get almost the same answer as what you're getting here. So just check whether you're getting the same. On 76 to 34 point you can, okay, in this case you can round off. In this case you can round off to whole numbers. You can round off to whole numbers. In this case, there are situations whereby the decimal points will be required. So let's round off to whole numbers. The first one then should be 176 to 34, 157, 352, 157, 352, 140, 493, 140, 493, 125 for 40, 125 for 40, and 112,000. So get the sum. $711, $519. $711, $519. Now, the reason why we are doing these two methods, this is very short. This is like a shortcut. But we are doing this method so that you can get the concept. Because there are questions that will tell you that the amounts were invested at the beginning, the amounts were invested at the end of the period, this and this was happening. So this one is very important. Kindly get the concept. Then after the break, we will look at discounting techniques. Discounting techniques. After the break, discounting techniques. Discounting techniques. So let's have a break of like 5 minutes. And as we've said, discounting is this determination of present value from a future amount. Determination of present value from a future amount is what we call discounting. Or rather, yeah, discounting. So we start with the first one. Present value of a lump sum. Present value of a lump sum. Present value of a lump sum is the first one. A lump sum, still the same thing as we've said, an amount that is paid or received once is what we call a lump sum. So how do we get the present value of a lump sum? Present value just say PV, present value of a lump sum is equals to future value times 1 plus R power negative n. 1 plus R power negative n. So look at this factor now. Look at this factor now. Under compounding, we were saying power n, positive n, because we were moving forward. But now, under discounting, we are saying negative, because we are moving backwards. So get the difference. Present value for lump sum is equals to future value times 1 plus R power negative n. So where this is future value, R is we said is the required rate of return. N is the number of periods, as usual, number of periods. Now this factor, the factor 1 plus R power negative n, the factor 1 plus R power negative n, we call it present value interest factor. This one, we call it present value interest factor. Present value interest factor. In this one, we can read from the tables. So present value interest factor, which is indicated as this present value interest factor, R percent power n. Present value interest factor R% power n. So let me share with you the present value interest factor tables. The present value interest factor tables. Just check on your WhatsApp. Check on WhatsApp. Check in the WhatsApp group, I mean. I'm sharing the present value interest factors table, present value interest factor tables that we use for discounting. Present value interest factor tables that we use for discounting. I have shared. Once you receive it, kindly let me know. Once you receive it, kindly let me know. I want to show you how we read. Okay, but that one we're going to do in an illustration. We're going to do in an illustration. So what do you need to add here? Nothing. Nothing. So when we are using tables, we say present value of a lump sum with tables. We say present value of a lump sum is equals to future value times present value interest factor R% power n. So this factor here, this is R, this is R, this is R% power n. Present value for lump sum is equal to future value times present value interest factor R% power. Because this factor should give us same figure as we have here. So let's have an example. I want to believe we have an example there. Let's go to discounting. Skip issues to do with quarterly discounting and semi-annually discounting. Let us go to discounting techniques. Discounting techniques, and we have an example there. We have an example there. Example says, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent? So we are saying, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent using present value? Okay, ignore that. Just ignore that. So here we have been given the future value. We've been given the future value. So here we're saying future value, it is the amount that you will receive in future. 172,800. Assume you are to receive 172,800 3 years from now, and 3 years. And the rate of interest is 20%. 20% per annum. So here we will say present value is equals to future value 1 plus R power negative n. Power negative n. So present value is equals to 172,800 times 1 plus 0.2 power negative 3 power negative 3. In short, how much are you supposed to invest today to earn to get 172,800 after 3 years at an interest rate of 20% per annum? Again, you say 100,000. 100,000, okay. 100,000. And or present value is equals to future value times present value interest factor r percent power n. So this one you write 172,800 times present value interest factor 20% power 5. 20% power 5. So 172,800. So this factor now, we are going to read it from the tables. We are going to read that factor from the table that I've just shared. From the table that I've just shared, let's go there. From the table. Are you there? Kindly confirm. Confirm we are together. Oh, it's power 3, sorry. Power 3, power 3. Power 3. Thank you for your correction. I want to believe you have the table that I've shared. Now, in that table, in that paper, there are two tables. We have upper one and the lower one. And you can see some formulas written above there. So you can see the first one, they have written present value interest factor, present value of received at the end of periods, end periods. And we have the other one down there, present value of an annuity of 1 per period for n periods. So the upper table is for lump sums. The upper table is for lump sums. The lower table is for annuities. The lower table is for annuities. Now we are talking about lump sums. We are looking at the present value for lump sum. So you will go to, if you look at the upper row, in table 1, the upper row, we have percentages. The upper row, the first row, if I can say, we have percentages. And in the first column, we have periods. We have periods. So like, for example, we have periods upper. We have 1, 2, 3, 4. Then we have these percentages, 1%, 2%, 3%, all the way to 20%. We want 20%. So now, in our case, we are interested in 20% at period 3. 20% at period 3. So you go to period 3 and move up to 20%. You read the factor that is there. Just like we were doing in multiplication tables. Just like we were doing in multiplication tables, that is what you are doing. You go to the period, then go to the percentage. Or you go to the percentage, you drop up to the period that is required in the question. So read the factor that is there. At 20%, period 3. 20% at period 3, you're getting. Write the factor there, 0.5787. 5787. 0.5787. 0.5787. Then you multiply now. 0.5787. 5787. So then you multiply by this factor, but not factor, but amount. How much are you getting? 99.99.36. That is just like 100,000. You can see these factors are rounded off to 4 decimal places. So, but that is what we are supposed to do. That is what we are supposed to do. Any question? Any question? Okay, fine. If no question, we proceed. Present value No, yeah, present value of an annuity. Present value of an annuity. Present value of an annuity. We have seen what an annuity is. Present value of an annuity. Present value of an annuity. And the present value of an annuity, we say present value of annuity is equals to the annuity times 1 minus 1 plus r power negative n over r. So have that. Present value of an annuity is equals to the annuity times 1 minus 1 plus r power negative n over r. Then we are saying this factor, the factor 1 plus 1 minus 1 minus 1 plus r power negative n over r is called present value interest factor of an annuity r% power n. Present value interest factor of an annuity r% power n. Thus, present value of an annuity is equals to the annuity times present value interest factor annuity r% power n. R% power n. I can't find 0.5787. Catherine, let's go back to that table. Let's go back to that table. The upper table, 5787. We are using the upper table, Catherine. Are you there? Kindly confirm you're there, Catherine. Go to 20% under column, under row 1, the top row, go to 20%. After reaching 20%, go down to row 3. Not 3, but count 1, 2, 3. At 20%, you should go up to 0.5787. You'll see, yeah, that's how we read this thing. So for the annuities, this is how we, and you should be able to compute this. You should be able to use this. Remember, this formula here, this formula that you're seeing here, this one, it gives us the same figure as what we have in the tables, rounded off to 4 decimal places. You round this to 4 decimal places, you're supposed to be getting the same figure. So nothing different. So let's see an illustration. An illustration present value of an annuity. Yeah, we have an illustration and a present value of an annuity. An illustration and a present value of an annuity. And they're saying, assume that a project will give you shillings 1,000 at the end of each year for 4 years. What is the maximum amount would you be willing to pay For that project, if the required rate of return is 10%. So let's do that. Now, when you are ever told to determine the maximum price to pay, and I saw that kind of a question in the last sitting paper. Every time you are ever told to determine the maximum price to pay, the maximum price to pay for an asset or for anything must be equal to the present value of the expected benefits. Must be equal to the present value of the expected benefits. Maybe we can have a look at, do you have your past papers? Let's look at the past papers. Just open your past papers. I show you that question. Past papers. It must have been question 2 or 3. Open your past papers. The August 2025 paper. The August 2025 paper. August 2025 paper. Which question? Question 4A. Not sorry, not that one. Now, yeah, question 4B. Question 4B. Question 4B. If you're there, you will see that required is advise an investor interested in Mara Limited on the maximum price to pay per share. So maximum price to pay, we say maximum price to pay is equal to present value of all expected benefits or cash flows. Benefits or cash flows. So if it's a share, to get the maximum price to pay for a share, it is the present value of all expected dividends from that share. If it is an asset, like for example, you want to buy a motor vehicle for commercial purposes, the maximum price that you're supposed to pay for that motor vehicle, it is the present value of all what you're expecting to earn from it. So that is what this question says. So back to the question. So what I'm trying to say is that some of these things you don't need to forget. Like I'm sure this is something that I repeated a number of times last semester. And you see it came in the exam. So maximum price to pay, kindly note, because it's a concept that will keep on applying. Back to our illustration. So they're saying, assume that a project will give you shillings 1,000 at the end of each year for 4 years. Annuity is shillings 1,000. Number of periods is 4 years. 4 years. And they're saying, what is the maximum amount would you be willing to pay for that project if the required rate of return is 10? R is 10. R is 10%. So maximum price to pay, this is present value of annuity. This is the present value of our annuity. So present value of an annuity, present value of annuity is equals to the annuity times 1 minus 1 plus R power N over R. So our annuity here is 1,000 times 1 minus 1 plus 1 minus 1 plus 0.1 power negative 4 over 0.1. So shillings. Get the figure. How much are you getting? That 169.87. That 169.87. Another person. That 169.87. Another person. That 169.87. We are waiting for another answer. Someone else kindly. Okay, let's assume that is the correct answer. Therefore, present value of annuity is equals to annuity times present value interest factor annuity R percent power n. So here 1,000 times present value interest factor annuity 10% at period 4. 10% at period 4. So 1,000 times. So now let's go back to the tables. Let's go back to the tables. So thank you, Tambua. Back to the table. We are using the lower table now. We are using the lower table now because this is an annuity. Go to 10%, drop up to period 4. Go to 10%, drop up to period 4. 10% to up to period 4, we have 3.1699. Oh no, just give me the factor. 10% at period 4 in the lower table. So I'm saying 3.1699. 3.1699. So you can see we are getting the same thing. That 169.9. That 169.9. I want to believe you've all been able to read the table. Yeah? Okay, fine. Next, we look at present value of annuity due. That is next time. We'll pick from that point next time. Number 3, present value of annuity due. Present value of annuity due. I believe we'll be able to look at all the factors, then we proceed to something else. Now, as I said, this is very important. Make sure, and that is why I don't want to rush. I do not want to rush because this concept is very important. If you get it at this point, you will have no problem going forward. You'll be very much okay. So make sure you repeat these concepts, do the illustrations that you've done. In case of any question, you will ask. Any question for now? Any question before we close? Any comment before we close? Yes? Okay, fine. If no question, we are going to close at that point. See you on Saturday. See you on Saturday. And enjoy, or rather have a good night. Have a good night. check whether start a class is to ensure we are recording. So now we have missed something, but no problem. So we are saying, so maybe just a recap. So we have said time value of money, it is that the fact that over time, the value of money changes. The value of money does not remain the same. And I'm saying, assuming here, now, that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here we have shillings 1 million. So we're saying the value of 1 million shillings today. This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. Which one is better? And we said, holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million because this, it may be, maybe if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount will be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Oh, okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction, and we have this direction. So this is to say, You can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years.